It's a good thing. Actually, it also improves your saving costs. Actually, what else? Does it have what you money? That's an example. That's where I mean, putting small money like that, it's about to pay a 0.5% interest. Yeah, so that's the one once in a while. Anything that is extreme. You need to more institutions could be every month. The assumption which are time for the deposits the minimum very small. Well, now we're getting some issues from That's the first one that I think that's what this one is.
Okay, so you see that's the primary one. Yeah, so that was good. I remember. You need to keep it. It's like that. Shuffle. That will be you see these shots. depending on the personal story, certificate, skills, activities, assets management, and then
when Obama came into the same place where and they are watching the local why? No, the second was that he said Obama had called him when Obama was during his campaign. Then he during the Bush administration. So Obama called him as well during his campaign. And I was imagining in an African country somewhere there were three people just like Paul, if you know what then there was another guy who showed us. No, I'm saying like in an African setting, someone came in and said, "Well, of course, this stuff. You know what? We'll throw you all out." And this is how we Africans. So if he has a good story, if he has a good solution.
Success of it's not like it's an plan we want to raise capital. It should be like business is already performing. So it's the case that so you have to do take them out.
That's so easy that anyone
In the environment, science market, probably with them, probably 2 months down. Then
not necessarily.
Yes, we are about to start.
Okay.
Emerging markets during the times pull out, sell them at higher interest rates, go up, what price drop. Always the investment makes matters a lot. So you find a country like Japan, the strategy was to wide investment in capital flow. Starting to
Good morning, ladies and gentlemen. Good morning. Did we have breakfast?
Good morning.
Can you confirm? We may need a second round. Welcome to our Research Challenge 2022. We are delighted to have all of you here in this year. And I know it goes without saying that over the last 2 years we have had different challenges. Our usual lives have been impacted and we've been unable to do the things that we'd like to do in terms of one, building our careers or enhancing our learning. And so we are delighted that this year we are able to host in person our Research Challenge. We last held a Research Challenge in 2019, where we had a couple of teams at Golf Course Hotel. At the time, we had actually a very smaller group, and that was the time when everything was free. We could move around easily. We had a much smaller group, and Daniel can attest to that. But I'm delighted that this year we are seeing a bigger turnout. Let's clap for ourselves there. It could be because we missed being out. We love being Waweru now. But we're also happy that we have more teams participating this year. For the first time, in terms of the East Africa Research Challenge, we have competitions in 3 countries running at the same time. So we have a competition in Kenya, we have a competition running in Uganda and in Rwanda as well today. And there is a good reason for that. The last time we had a Research Challenge, it ended up being a scuffle between Uganda and Kenya. The top 2 teams, number 1 and number 2, had very narrow point difference. And there was a divergence of opinion on which university was better. Was it Makerere University or Strathmore University? And that question was handled up to London. To avoid future problems, we decided to have in-country competitions, so we give opportunity to all our universities to learn. But we are also delighted that finally Makerere was able to break the East African voodoo and demonstrate that we have high-quality students in Uganda who can compete at a regional and also continental level. And so we are happy now that we have the challenge in Uganda, that we are getting more universities and giving more people opportunity to showcase their skills. This year, we have 5 teams in Uganda. We have Makerere University Team A, we have Makerere University Team B, we have Makerere University Business School, Uganda Christian University, and Chambogo University. I believe this is the first time for UCU. Am I wrong? I think it's the first time for UCU. No? Second time. Wow, good to have you. Unfortunately, this year we are not traveling, so everything is going to stop in Uganda. But we look forward to having you more in future years until we normalize, and we expect to go back to the model where we take our students to the New York for the overall challenge. Anyway, the Research Challenge is really about offering you a big challenge and also a bigger opportunity. This is our tagline for now. What we are looking for is to introduce students in university to what the CFA Charter represents. And the CFA Charter is a graduate level credential. By graduate, we mean you should have finished your bachelor's degree by the time you finalize the program. Because the level of the content assumes that you have done or you have covered some of these topics at the university level. The charter is held by over 150,000 individuals in 154 countries. Only, I think I should add that. There are only 150,000 individuals who qualify as CFA charter holders. So these are individuals that have been trained, have been attested to be able to manage money professionally. And so they are recognized by authorities, regulators, and publics and policymakers that these are the individuals that have the right credentials to manage money. And so what we are trying to do today is to introduce this information to you. What does it mean to be a professional money manager? And we are using the equity asset class as a way to introduce this knowledge to you. There are more than 425 universities around the world that have decided or have chosen to incorporate the curriculum of the CFA Institute into their university curriculum. And we are working with Makerere University, UMI. We are having discussions on how we can enhance our finance investment programs to mirror and to include curriculum based on what the CFA Institute has done. So we can see that there's a lot of convergence. There are things being done at the back end, but also there are things we are doing in the front end by bringing a research challenge to you. We are introducing knowledge to you, but we're also working to change things at the back. So why do people do the CFA Charter? Many individuals want a globally recognized qualification that will prove their competence. I agree with this statement. When I left university in about 2003, I had a Bachelor of Arts in Economics. I did about 10 interviews in the top banks at the time, and the answer was always no. And we would be about 1,000 people competing for being tellers. By the way, being a teller was a big deal back then. Right now, it doesn't exist. I think it's left in a couple of banks. But banks like Standard Chartered are phasing out that role. But at the time we left university, it was the easiest job you could start with if you wanted to start in the banking industry. And so a thought came to me that I don't want to be in this situation where everybody I went to nursery with, primary, high school, and university can come and attend an interview with me, because those were so many people I'd gone to school with. So I wanted something different beyond my Bachelor of Arts Economics, and so I took the journey to start the CFA Charter in 2007, finalizing in 2012, and that by 2012 we were about 6 people who had the qualification in this country. And so after that, it became a lot easier for me, and I've been able to enter some rooms or being invited, and I'm a sole candidate in the discussions that follow. So among the countless finance degrees around the world, the CFA Charter has been claimed by the Financial Times. They claim that it's the gold standard. It is the ultimate financial credential. There are many credentials within the finance space, but the one that a lot of people recognize that if you are a person who has gone through this rigor, you are a person of high quality. For the university teams here today, I think this is something you share. You have done a portion of the curriculum, writing an equity report. Writing an equity report requires you to touch on so many different facets of the investment space. You have to do valuation. You have to build a business model. You have to do risk assessment scenarios. You have to stress test. You have to understand the macro, the context, the industry within what you're looking for. You have to understand such aspects like Basel rules, Because if you are doing an assessment of a bank, you need to understand the Basel capital rules. So there is all sorts of information that you bring together to allow you to write the final report. And I'm sure your experience through this has shown you that there is something more you can get by doing a professional certification of this caliber. We are seeing a growth in candidates in Uganda, in East Africa. We are seeing an increase in numbers. And we see that in the last financial, that was in 2018, we had over 300,000, in excess of 300,000 students sitting different exams at the CFA Institute. The reason for this is that a lot more students are getting introduced to this program much earlier, and we are encouraging people to take it up when they are much younger. I know most of my colleagues will share, if you, at the tea break, they can share with you that it's very difficult to do this program when you are much older. It's not impossible, but it makes more sense when you start this journey a lot earlier. So we have, in Africa, we have about 5 societies, and we have slightly under 300 charter holders in Africa. Nigeria, Kenya, South Africa are really the key markets. Uganda, Ghana, Zimbabwe, we are the upcoming markets, where we see about 30 to 50 charter holders within that space. So what we are seeing is that the more advanced African economies have more charter holders, and the emerging African economies are also looking to develop their capacity. A lot of people ask us and come to us and ask, where are the jobs? I have a finance degree, where do I work? And one of the things we share with them is that having a basic degree like finance or economics or statistics, you have not differentiated yourself enough to be able to be positioned in certain sectors. You are still a generalist. And so what we are looking to do as a society is to highlight you from the very beginning that you need to really position yourself and highlight yourself as unique, as different, because your value will come from your differentiation. So we believe in relationships and of course diversity, and we want to encourage young ladies, young men to take up this opportunity, one, to learn through the research challenge, but also to build your understanding as you go along. If you want to be successful, I think you need to think about the CFA Charter much early. And I'm delighted that all of you today have agreed to take part in the research challenge, which is one of our ways of introducing you to what the CFA program carries. So quickly here, this is something I don't want to spend much time on for today, that we discuss different things within the CFA program. We teach you portfolio management, how to manage wealth, asset classes, ethics and professional standards. These are things that we touch on as we do the program. For the purposes of the research challenge, we extracted just one. We looked at equity investment, and we tried to teach you how to write a report using the facets of borrowing from the curriculum of the CFA Institute to help you understand what it means to review a company like MTN. I know last year that was a big issue. Everybody became an analyst, and it has become a theme on Twitter. For every quarter, there is people shift specialism. Right now, everybody is a specialist in Ukraine, right? Just a month, in December, everybody was a specialist in MTN and why it's having challenges. But there are some professional people who understand these facets, whose day-to-day job is to analyze MTN and guide investors on what needs to be done. What we are trying to teach you today is you can become one of those professional individuals. that understands what it takes to guide a pension scheme that has 10 trillion shillings to make a decision to buy into MTN. That's a very big decision. It's a lot of responsibility, and we want to give you the right tools. We are using the research challenge as a way to demonstrate how to think like an equity analyst. And it's just a subset of the total knowledge we have. Globally, the key employers for charter holders are really big banks. Even in Uganda, most of our colleagues work for either the big asset managers, the big commercial banks, and investment managers. So we see that managing money or understanding how to guide decisions around money management is what we are training you to become. So, all right, so this is not necessary for you. Do we have anything on the program? Yes, good. So the research challenge, that was a bit about the CFA Society program and the Institute, but we are here to discuss the research challenge. We all know how it works because we have walked the journey over the last couple of months. We are here to witness the presentation from the 5 teams that we have today. We are here to witness and to see whether the exercise they have done over the last 4 months has yielded the quality and the outcome that we had wanted or envisioned at the beginning. What we wanted for you to benefit out of this exercise was, 1, we wanted you to have a real-life learning experience as an equity analyst. What does it take to analyze a company? The skills you learned in this exercise can be used in 4 different areas. You can use this information as a private equity analyst. This is analyzing companies that are not listed on a stock exchange. You can use this information to analyze a listed company like MTN. You can use this same information to do mergers and acquisition, where 2 companies are trying to combine. This same information would apply. Those are called corporate finance specialists. You can also use this information to do economic analysis. But this is done at an industry stage, so if you are a sector analyst, this would be the same information you would use. So it just giving you this experience as an equity analyst, we are showing you the various areas you can work in if you pursue and if you feel this is the course or the direction you want to take. We have also been trying to teach you how to prepare and present material in a professional manner. And today we are here to complete that process by putting you on the stand and seeing whether you are comfortable with the mic or whether you will throw it down in a minute. But one of the other things that is silent, but I've found to be very useful for teams, is research challenge helps you develop your resume. Most of our previous participants have ended up either interning or working for investment managers, because when they go into an interview room, they are able to articulate the process of equity valuation with clarity. This is a question that we take for granted, but a lot of people assume they understand what MTN was about. Where was MTN going? You could see people that you thought were more mature in this business not being able to articulate why they have a certain view. This is something that for you today, you have built or the foundational stone for being able to have that view. And so this is very powerful for your resume, and I encourage you to highlight it. I encourage you to put it there boldly that I have participated in the CFA Institute Research Challenge, and when you call on me or call my colleagues and come in for an interview, you remind me. You remind me that I was in the Research Challenge in 2022. For me, those are 10 points. Okay? So this is something that is very, very big, and a lot of our previous but are working in the jobs I've already highlighted. We have also given you access to mentors, the individuals that you've been working with over the last 4 months. These are people you need to work with because they are already in the industry. They can act as your referees. They can act as sounding boards. If you have a question, please, you can reach out to them. They will be able to continue guiding you, and this is powerful as you grow in your career. And finally, of course, the last thing we have done is networking, and that's why we are here. We are here to network, learn people in your cohort, interface with other industry leaders, such that you build familiarity, and this can also help you down in your career. So these, for us, we believe are key and very important aspects of the research challenge. So in terms of where we go from here, we are having the in-country finals. We expect to have the regional semi-final. So every country is going to have a winner. And this winner then will go to the Africa regionals. We expect to have many, actually the regional here would be EMEA, it won't be Africa. Because we are blanketed under Europe, Middle East and Africa, so the regional will be Europe, Middle East and Africa. Because we expect many universities at that stage, because you are covering Europe, Middle East and Africa, we expect many universities. There will be a semi-final to reduce the number, and then there will be a regional final for the EMEA region. From the EMEA winner, we will then have one recommended to the global final in New York in May. So what is coming up next is that right now, 2nd March, we are having the country competition. The winner from here will go to the regional, which should happen in 7th, 8th April. And then we shall have a 28th April, we shall have the regional, and then we shall have global. The difference this year is these are all going to be virtual formats. And there are some obvious reasons why they are provided as virtual. One, it's a challenge to transport big numbers of people across the world today. It used to be easier back then, but has gotten a lot more difficult. Some countries are easier to move into, others are more complicated. So to minimize that disruption, the decision was taken to have a virtual competition this year. Of course, we also have to be mindful that things have changed in the last week with the cutting off of within Ukraine and Russia has also disrupted global travel around that area, the Middle East and Eastern Europe. So this seems again to be a very rational decision. It's disappointing for some teams, but we believe that the benefits we have highlighted override what we have missed out in travel. So we have a couple of teams, and I already highlighted those in Uganda. And we say that there's a competition already happening in Nairobi today and Kigali. Today, our judges, we have Mr. Jojo Tim and Sagotre Bukomeko, who are here to judge. Samuel, you're a judge, right? You are seated in the, and Daniel, you are a judge as well. So these are going to be the ways they are going to score your presentations. We are going to emphasize the thoroughness of your financial analysis. Financial analysis is, from our perspective, is a top-down. We start with the country, the macroeconomics, we bring that to the industry, which is the banking sector, and then we look at the company itself, how it performs. So how thorough you are in understanding the cascade of information. A company cannot outperform the country it is in, right? If you were a company in Ukraine today, you cannot say I'm going to have a growth rate of 10% in Ukraine. It doesn't make sense. You are as good as the jurisdiction you are in, so how thorough you are in understanding this layer of information is important, so we give that 20 points. Valuation is how you convert the information in the financial statements into something meaningful for decision making. the criteria you are applying, the principles you are applying there are important for us. And so we also apply 20 points. We know that environmental social governance factors are becoming important. And we've seen that in the most recent case with Russia, where the way the government has handled its situation is impacting companies. So how you bring on board that aspect into your valuation can also be a value addition for us understanding how the company is running. So we have 20 points on that. We have some 2 points that are qualitative in nature. Presentation, how you are going to hold yourself on the stage. I can share that the bulk of your work as an investment manager, investment analyst is speaking. You'll be like doing this all the time. Either you are meeting a board of directors, a board of trustees, you are speaking at an annual general meeting, you are presenting, you are pitching an investment opportunity, you are always going to be speaking and presenting. We want to see how you do that today, and we think 20 points are good to highlight the importance of presentation. Question and answer is how you manage to interact on the spot. It's easy to regurgitate what is already on a slide, but we also want to see your thought process in a timed environment. So we want to know that you have read, we want to know that you have prepared your research, and you are familiar with the different concepts and you're able to deliver them in a short format. And of course, we also want to see that the entire team is involved. So we should not have one lead person speaking and everybody else is like a choir. We expect to see the team dynamics clearly, and we want to see that all the team members are familiar with the concepts and are comfortable in the presentations. And of course, finally, we have some few points for the quality of your slides. I don't know if you have heard this phrase, death by PowerPoint. It's a real thing in the corporate world. Somebody will get a whole book and just get it and dump it in the slides, unedited. They are not legible, they are not easy to follow. PowerPoints are supposed to help you have a conversation. They are just aids. They are not a book. And so one of the things we are going to be looking at is the quality of your thoughts and how you use your slides, and also the quality of your slides. They should be easy to follow and easy for us to use. For today's case, for Uganda, we are going to be looking at Stanbic Bank Uganda Holdings Limited, which is a listed company on the Uganda Stock Exchange. And we have spent time working through this with our industry mentors. And I'll take this opportunity to thank our industry mentors who are listed there, the graders who are represented by ESCA at the back, and of course today we have our 4 judges in front of us who you will be presenting to today. I'll also take this opportunity to thank our sponsors, UAP Old Mutual, CMA Capital Markets Authority, who have given us the financial resources to be able to host you here today. We are delighted to have the Capital Markets Authority to speak to us today. And I would like to take this opportunity to invite a representative from Capital Markets Authority to speak to our audience, and we will share a few remarks from there. Director Samuya, thank you for coming. We are delighted to have you. And kindly encourage these young men and women on the way forward. Okay, so thank you very much. I'll speak to you in a few minutes. Let's take some remarks from our sponsors, the Capital Markets Authority. Thank you.
Thank you very much, Alan. Ladies, gentlemen, good morning. I had Alan asking whether you had breakfast, and now I seem to understand why he was asking that question. Good morning once again.
Good morning.
No, that sounds like you had some breakfast. My name is Dixon Sembuya. I'm the Director in charge of Research and Market Development at the Capital Markets Authority. I'm actually standing in for my Chief Executive Officer, who was supposed to be at this particular event, but unfortunately he had to attend to an emergency, so he delegated me to actually represent him and read his remarks verbatim. But I think before I get into his remarks, I also have a story to tell. I graduated with BCom accounting. That's a few years back. I think when most of you had just started school. And I was a member of a student club called Students in Free Enterprise. We used to call it CFA. But I think it evolved and it has another name now. I don't know. Are you aware of Students in Free Enterprise? Anyway, I was a member of Students in Free Enterprise. And what happened is that when I left university, you're pushing your CVs left, right, center. I walked to the director of Students in Free Enterprise and actually told him, you know what, I'm looking for a job. I've been a member of CFA, as we used to call it, and here I am. I'm out in the world, and I need something to do. And so he referred me to a gentleman called Mike Musau. Now, Mike Musau was the chief executive officer of a small boutique investment advisory firm. And so I went to Mike and I told him I've been referred to you. And that's when I got my first job. And so my first job was as a research analyst. Okay, so here I am, coming in from an accounting background, and I'm thrown into the deep end by my boss almost immediately. Like, I wanted to prepare a research report on company ABC. I'm new to this, I've never done it before. But, to cut the long story short, I learned quite a lot. I learned quite a lot about financial markets, I learned quite a lot about research, I learned quite a lot about research analysis. And a few years later, I joined the Capital Markets Authority. And of course, being a regulator, financial markets regulator, lots and lots of stuff as far as financial markets are concerned. And I think I also had colleagues who were pursuing CFA at that time. And they also inspired me. And I also did my CFA. I eventually did my CFA. Though I'm not a charter holder yet. But anyway, that's a chapter in my life. That has taught me a lot. A lot of hard work, a lot of sacrifice. I think I became very rare along the way. But like they say, no pain, no gain. And I think Alan talked about, doing your CFA when, you're a bit older and you have commitments. It's usually quite a task, striking a balance between family, friends, events. It takes quite a bit from you. So this is actually the best time for you to start on this program. I think it's a very rewarding program. Alan pointed out the CFA program being the gold standard globally when it comes to finance credentials. Okay, this is the right time for you to start with this. There'll never be a right time than now. And trust me, the rewards are there. And like they say, no pain, no gain. Okay, so I'd like to encourage you. This is very doable. It's doable. There are others who've been there, and I think most of you don't have lots and lots of commitments. I can see you look very young. Majority of you look very young. So I don't expect a lot of commitment. So this should be the right time for you to actually take this on. And get to the top end as far as the financial industry is concerned. And there are lots of opportunities. And you're going to command a lot of respect. When you walk into a room like Alan shared his experience, you're going to command a lot of respect. It will give you an edge. You'll have an edge both technically. You'll basically just have an edge with these particular credentials. So allow me to encourage you. Okay? Start on this journey. It's usually a very long, narrow, winding journey. But I think everything that has a start must come to an end. Okay? Just stay focused, start on this, and surely the rewards will be there. Okay. I think I've always been taught about delayed gratification as a virtue. Okay. So you sacrifice now, so that you can benefit in the future. Okay. So I'd like to encourage you, take this up. It's worth every minute that you will spend in as far as pursuing this is concerned. So allow me to get back to my CEO's speech. I'm a man of very few words, but at times I get carried away, especially when I'm talking about CFA. I think I got a bit carried away. So allow me to get back to my CEO's speech. So I'm going to read this verbatim. These are not my words. However, before I start the speech, the Capital Markets Authority has a memorandum of understanding with the CFA Society of East Africa, and part of that MOU, or part of the activities under that memorandum of understanding, is providing support to activities such as the research challenge. So all this is basically part of the CMA, CFA Society of East Africa MOU. So allow me to start on my CEO speech, verbatim. So ladies and gentlemen, all protocol observed, good morning. I think I've had the pleasure of telling you good morning so many times. It is with great pleasure that I stand before you to deliver my remarks during this auspicious event. Allow me to start by thanking the CFA Society and the CFA Institute and all other partners for putting together this research challenge, which is crucial in building future capabilities as far as research in capital markets is concerned. In a special way, allow me to also thank all participants for not only taking interest in the research challenge, but for also making it this far. I think you're all heroes. You can clap for yourselves. So, ladies and gentlemen, the role that is played by timely and quality research in the capital markets cannot be stressed enough. Quality research improves the quality of information available to all investors, enabling that efficient allocation of capital. So high quality research is the cornerstone for investment decisions by all categories of investors. This indeed demonstrates that it is imperative to build research capacity in order to facilitate effective decision making on the part of investors. So research is critical in that decision making process. Alan has highlighted that as well. So high quality research is crucial in minimizing information asymmetry in the capital markets. With the right research skills, research analysts provide information to investors, helping plug in information gaps. An informed investor is an empowered and confident investor. A confident investor will allocate capital, stimulating market vibrancy and liquidity. So high quality research is a very critical component in as far as driving market activity and the resultant liquidity. So we believe that high quality research is actually key to unlocking market vibrancy as well as driving liquidity in our markets. So this is really important in as far as trying to create a much more vibrant market and supporting investment decisions. So what you've done is important. So in Uganda, the role of providing timely and quality research in the capital markets is played by investment advisors as per the Capital Markets Authorities Act. So investment advisors are empowered to analyze and publish reports on securities as per the Act. However, we do note with concern the dearth of research coverage for local listings. Okay? So a case in point is the recent MTN IPO, where coverage by investment advisors was minimal. I think Alan alluded to that. Everyone became an expert in MTN. We had all manner of armchair analysts, firing off all these manner of reports. And I mean, you just look at the assumptions. I think you've all gone through the development of a research report. Okay, key things are your assumptions. The other key thing is your model, how you model and focus into the future. Okay, you look at their discount rates, ridiculous. Okay, so we had all manner of people firing off all these types of unfounded reports, and the public actually took what they were reading at face value. Okay, there was no clear investment cases. No one would actually break down the business model clearly. Okay, and so the public was actually relying on such individuals to make that all-important investment decision. And now that is where you come in, as the experts, as people who can analyze a company. You're very critical in as far as enabling or facilitating investment decision making by others. So others will rely on your knowledge, your analysis skills to make that all-important investment decision. So a case in point is the recent MTN IPO, where coverage by investment advisors was minimal. We noted that we didn't get a lot of coverage from those we licensed. So key among remedies to this challenge, that is the lack of that in-depth research and coverage, include the deliberate enhancement of research capabilities of investment advisors and future investment advisors. So I believe you're the future investment advisors. You're the future of the financial industry. Okay? I think if we build those capabilities early enough, okay, then I guess we shall have more coverage of local listings as well as other listings of interest. So this competition is very important in as far as creating a wide pool of future investment advisors who can actually do that valuation, who can do that modeling, and you name it, to enable decision making in as far as allocation of funds is concerned. So I'm happy to note that stakeholders such as the CFA Society of East Africa and the CFA Institute are rising up to the occasion of building future research capabilities through the research challenge. So this is important in as far as building research capabilities for the future, in as much as there are also some near-term steps that are being taken in order to give our investment advisors tools. So additionally, CMA is looking at widening the pool of investment advisors who can undertake research on capital markets by amending the Capital Markets Act to allow for individual investment advisors. Currently, all investment advisors have to be corporate entities, have to be corporate bodies. But the authority is looking at amending the act to allow for individual investment advisors. So that would essentially mean that people like me and you, who are not necessarily a company, and we have the skill, we have the skills, and we can do the analysis, then we should be able to apply to the authority and get that recognition or approval in order to undertake that analysis. So this will help in supplementing existing investment advisors who are all corporate bodies. So as we focus on enhancing research skills in the market, there is need to develop capacity in business valuation, okay? Especially in the private market space. Typically, a business valuation happens when a business owner is looking to sell all or part of their business or merge with another entity. So non-aggressive valuation is key to unlocking access to much needed capital. So capacity building in business valuation will also be critical in increasing access to capital. So I believe what crowns any research report is you being able to come up with that intrinsic value. Okay, the worth. I saw the companies that you'll be analyzing, being able to come up with the worth of that company. Okay? Now, valuation, I don't know if it's an art, if it's a science, but I think having a good valuation is critical in as far as raising capital is concerned. And we've learned that over time. We've seen it over time, where valuations are aggressive. Normally, they tend to put off prospective investors So that points to the importance of having non-aggressive valuations. And all that can only happen if people have the tools, if you have the skills to actually come up with a value that is reflective of the future pipeline of the company that you're analyzing. Because ideally, the value should reflect, that future pipeline growth, projected growth. Okay, so you should be able to come up with a value that is quite reflective, and we can only do that if we skill up and if we participate in this kind of challenges. So, ladies and gentlemen, as I conclude, I would like to broaden out the need. I would like to point out the need to broaden the research challenge through a mock competition using dummy funds. While I appreciate, this particular format, I believe there's still room to make it better. There's still room, to bring out certain other aspects in as far as, undertaking a research report is concerned. I think this can always be taken elsewhere or taken out of the room, and we find ways of making this better. So finally, allow me to extend my sincere appreciation to UAP Old Mutual. I think they're also part of the partners. Allow me to extend a sincere appreciation to UAP and the 5 teams participating in the challenge. In advance, I would like to congratulate the winning university team. So I'm congratulating you in advance. I can see the teams which are clapping. I think they can tell that they're on the verge of winning this. So I will close by reiterating that the Capital Markets Authority stands ready and willing to support initiatives by all our partners aimed at building the research capacity in Uganda's capital markets. I thank you for God and my country.
Thank you, Director Semwera, representing the CEO of Capital Markets Authority, for those insightful words. I know our participants today are inspired, knowing that the industry is growing, jobs exist, so their pursuits are not in vain. I think that is something that all of you should clap for. And we're also delighted that there is a review of the CMA Act to permit individual advisors. We believe these are the cornerstone for supporting SMEs and developing lower segments of the market. And we are happy that the industry is maturing. And our efforts on the society side is developing the new talent that will be able to take up that mantle. So thank you very much for those words. Today I'm going to introduce our judges quickly to the team, such that you're able to visualize who you'll be speaking to. I'll start with Mr. Daniel Obol, CFA. Kindly wave to the teams. We have Mr. Godfrey Bukomeko, who has been with us in the Research Challenge for many years, and he has seen the Research Challenge in all dimensions, because he was a participant, he was a mentor, and today we are graduating him to a judge. Mr. Godfrey? We have Mr. George Otim, who is an analyst himself. He has written research reports. For many years, he has been in corporate finance. He has handled mergers and acquisitions, so he's well versed with everything you're going to be talking about. So if you know anybody who's going to give you low points, that's going to be George. George, Karim. And finally, we have Mr. Samuel Sanya, who has a passion for young talent. He's always pestering me, how many charter holders do you have? Why don't you, who is writing a report about X? Like, we need to develop talent. Today we are here to introduce to you some of the talent. These will be the analysts in the next 5 years. These will be the people who shall be harassing for our equity reports. Mr. Sanya is also a representative of CMA, So it's also a quality control aspect in your presentation. We don't want you to say things that are illegal or are not appropriate. Those are jokes. So these are our 4 judges who will be judging your presentations. But just to give you just some housekeeping rules, I'll do a few, and I'm going to invite Ruth to do the remainder of the housekeeping rules. The key for me is that let's keep to the time allotted. So if you're given a certain amount of time, please keep to that time. 2, we highlighted that we will be scoring team involvement within your presentation, and we want to see you comfortable on the stage. We don't want people hiding in one corner. It always doesn't look professional. So feel free to use the stage. Take up as much space as you like on the stage. And we want to see all the team members showing us that they are all aware of the material within the presentation. The Q&A would follow after your presentation, and it will be led by the judges. The judges will ask you questions, follow-up questions after your presentation, and they will be scoring you on the basis of that. So there will be 2 things. There will be a presentation which will be presented within the allotted time. And after the presentation, there will be a question and answer session led by the judges. Okay? And in these 2 sessions, we expect to see team involvement in the main presentation as well as the question and answer session. All right? So for me, those would be the key things that I would like to share. Ruth, would you like to come and share any other housekeeping rules you would like us to have?
Thank you, Alan. Good morning once again. My name is Ruth Amongin, Society Administrator, and I think I have interacted with each and every team. And I'm wishing you all the best in this competition. Bring your best foot forward and display your best talent. I just want to make a quick housekeeping to what Alan has mentioned already. So the protocol is that once we begin, all the teams will be ushered out of this room. We have a holding room just across, because you're not allowed to watch the other team before your turn comes. So you will all go to the waiting room and we'll call you in one at a time. Then to the judges, just for purposes of avoiding bias or anything, we have allocated team numbers to each team. So the teams will know when we are calling them, we'll tell them you're team number 1. So when they come in here, they're not supposed to mention their university. So they'll just come and say, this is team 1, because they're the first to come in. So on your grader sheets, on your judges sheet, you just write that as team number 1. So when we're collecting the sheets later, we'll know who came first, who came second, third, and fourth, like that. So the teams there will give you the sequence on how you're going to come in. So when you come, please do not mention the name of your university. Just mention the team that we have, the number that we have given you from the holding room. So that will be for round number 1. So we'll go for round number 2 after the break. So we'll tally the results from the first round to select the best 2 from this first round. Then the best 2 from this first round will now be the ones to compete in the second round. Meaning the other 3 will be allowed to sit in the room. Then even in the first round, after your presentation, you're free to stay in the room and then now listen to the other teams that are presenting after you. Is that clear? Yes. Any questions? Okay, thank you so much. So I would like to ask the teams to use. So Alan has a great suggestion. Before you break out of the room, we'll take a quick picture with the judges and everyone here, then they can break away. I think the judges have a question.
The judges have a question.
Yeah, how long will the presentations take?
How long will the presentations take?
So the presentations are 10 minutes. So we have a timer. Someone will be just, I think, at the back. And we have a placard. We'll lift it up when you're left with a minute. And another one telling you to stop. So we have a timer. And
I think it would be helpful for the person to be closer. Such that,
so the team presenting here, please be mindful. You can have, I know you've practiced this and you've timed yourselves, but just to remind you, we'll hold that the placard somewhere here so you're able to be signaled when your time is up.
Sorry.
yes, please.
Does the Q&A session also have everything?
Yes. So yes, Alan, please go.
Go ahead.
Okay, so there's a Q&A. So after the 10 minutes presentation, the judges will ask you questions for another 10 minutes. Then on the second round, the Q&A is unlimited for the judges, but the presentation still remains 10 minutes. But the Q&A is unlimited.
So we have a first round,
Yes,
and then we shall select what, the top 3?
top 2.
Top 2.
Yes.
So they will have a second Q&A
Second presentation.
and Q&A.
So they'll present afresh for 10 minutes, and then the Q&A from the judges is unlimited. You can ask them as many questions as you wish.
Okay.
Then from there, we now select the winner.
Okay. All right, I wanted to suggest a quick photo from this side. It looks very nice from this angle. With everybody seated and the judges, some of us can stand for purposes of our calendar, which will be launching soon. Ruth, let's stand here such that they can capture the rest of the room. No, you just the way it is. The way they are. They can stay seated. Yeah. No, they can stay seated. I think he can capture everybody from there. For our new, we're trying to monetize everything. This is the digital space. NFTs work. All right, thank you. But people, you can smile. It's okay. All right. That's it. Thank you. Still have to do more? I change the pose. Great. Thank you very much all. So we have been guided. The teams would be moving to the holding area, and then we'll be able to start our challenge. Bon chance to everybody. Best wishes.
Yeah, and you see the thing is, how do you see it? I think it's okay. Just think it creates sort of okay. Yeah. Correct. The first is 74. So you get the 50. Yeah. You have 4. Yeah. Yeah. You have to, because it took you to have. Correct, yes. I feel what you mean. Psychologically, you give me that. Yeah. The problem is like they go out, probably give hints to the other team, interact and stuff. So it's also yeah. Take a breath.
Yeah.
Sure.
You're calling me.
Yeah, the model is all the
No, no, we can
you need to use minimize the variance. What we try to teach them is to define because each model has its policy. So if you just use with another model, whatever you arrive at the price.
So that is when you're ready. So I'm sorry.
How did you No, you didn't make it.
Yes, of course. By getting that
So they won by smart by like 1 year. One of the other those two.
Now, because you will CMA, so you know.
Yeah, people are not working, so you are disconnected. And then that's good stuff.
And actually, I was actually teaching this yesterday. So I was saying something. So if you have time, please pass by today and try and understand the topic. This guy, that's one Damadora. It's called the Dean of Valuation.
Okay.
But I'm really he's the New York University valuation expert. He's even quoted people using like modeling cost of capital and data risk premiums. Publishes things like that. It's a social report. So he says valuation is an art and science. Because numbers and words.
Because you have to
Because most of the things that system it's tough, no? Look at the economy. What's the economy to grow by 6% in the next 20 years?
Yeah.
What are the sectors that are going to grow? What is going to grow?
Without the travel,
Hopefully we don't come and look at them.
they want to see you.
So the whole of the country, like financial inclusion, very low. But they are all non-banked. Phones people have,
And no one is
all over the world, all over the
really
country. So
interested in getting out.
easy to put into the market, technology is available. And look at it for us, you know how to break down and then count what are 5. So I was trying to show them that it's not just positive, sit down, get financials, go there, do a CFA, but you don't understand the story behind it.
Yeah, that's the thing. But you also kind of have your own interpretation of the story. And then you get the models and you see where that's.
And actually,
Actually,
someone is taking whether that I think for someone looking to your money. Someone will basically look into because your story will be in your assumptions.
Yeah.
let's say scavenging capital. Someone comes and puts in a sustainable growth rate, it's what we 10% because you know that the G is a double square. If you put a very high growth rate, people stop at what these pockets resources from the lower side is reducing, but it reduces the R minus G, so it is you can't now get your valuation so high.
You only need one shot.
The story might find that then people are able to buy it. And then the thing also, the last research, when this gets going on, then you do the amount of the country now taking the best case scenario.
Very unique
You
space.
don't have those scenarios.
That's what the numbers
It's quite good because you have to have a coefficient.
Yeah.
Otherwise,
We can say this. But I think also it is well, from my experience, I generally find it so that's they just know, of course, you get a global only as a class, your specialist now the only issue is that how to do something else first. No, they are not so necessarily how to do stock exchanges. So ideally, one for CFA was designed for portfolio management. We're now seeing new specialties. In PE, valuation, you're seeing now how focus your conversation what to do, right? Well, because it is for because I also had to do investment for private equity. And I sometimes need to fine tune but it's not as intense. Even when I did so applying for already public but we average our biases. But if they give was reducing 8 out of 20.
Because we also just understand how well they can say for
a margin. A lot of people don't need. You understand that's correct. Yes. So you pick a model.
And how did you arrive at those people?
Correct. Yes. And then that's the most understanding. It is intense. Yeah. But most of the things they were teaching me, especially application of resources. What I didn't know is what is asset class pricing, but I need to take but now I just want to so I had to so basically it's if you are familiar with what happened is services. Only I think it's only need to know. You need to pay. Yeah, so what I don't check. Okay, so you have to do something. What does this mean? Yeah. Yeah, because I know they know how. Yeah.
Because that's all time it's read the chapter on your aspect. And every day you add something different from we're reading new material. There you go. So what year did you go back?
That was the most challenging.
I never miss.
You really feel like you read something.
Yeah, it's a caption. Yeah, it sounds interesting.
Thank you. We are Team 1, and we are here to present about Stanbic Uganda Holdings Limited, which is actually one of the biggest banks in Uganda. I am Regan, with my team, Samson Nwamanya, Jacent Nabachwa, Kemikisha Priscilla, and Shadia Nadumba. We are here as a team. We are basing our presentation to ascertain whether an investor can, in Stanbic Bank, can buy, hold, or sell a share in Stanbic Bank. After carrying out analysis, putting in different models and different metrics, we as a team, we came up with a hold recommendation with a target price of 28.36, representing an upside of 9.08% in regard to the closing price of 26.0 at the 10th December 2021. But before we go further, let me invite Shadia to take us through a business overview. I thank you.
Thank you so much, Regan. Stanbic Uganda Holding Limited is a financial service holding company listed in the USA. It was incorporated in 2020, and as per 10th December 2021, its market share price was Uganda 26, and its market capitalization was 1.23 trillion. Stanbic Uganda Holding Company has so many subsidiaries, and those include other subsidiaries, but the main one is the Stanbic Bank Uganda, which has a different business units. That is the personal and business banking, then corporate and investment banking, which have a profit after tax that is 82 billion and 151 billion respectively. It also came about with other services, that is the mobile and internet banking, ATM and point of sale, which we as a team analyze that they will lead to more profits and market share. As such, these services kind of justified our recommendation of a hold. Let me call upon Regan to take us to the reason as well to on that recommendation. Thank you so much.
Thank you so much, Shadia. As a team, we came up with a reason as why we are issuing a hold recommendation. We came up with 5 key major drivers to justify our recommendation. That is corporate restructuring and its long-term return, massive digitalization and innovation, strong competitive position and market share, declining in profitability and indicators, and also investment in oil and gas. Let us go through these ones one by one. When you look at Stanbic Bank, in 2020, after being incorporated, they came up with different subsidiaries, among of which there is a major, which is the bank. And after them incorporating, they came up with these different subsidiaries, whereby we analyzed that these subsidiaries in the near future, they are going to contribute to the profitability and the market share of the bank. And we went ahead also, we analyzed the massive digitalization. However, March in 2020, whereby we saw we are in COVID times, and we are seeing that commercial banks faced competition from different non-bank players, such as mobile money. But we are analyzing that Stanbic Bank is not seated down, whereby they invested heavily in digitalization, whereby among the subsidiaries they came up with, there is fintech, where they invested in software, whereby they also came up with smart applications, such as FlexPay, where their clients can actually reach out to pay utilities and other transactions they want to make. And also, we analyzed that Stanbic Bank in 2020, they did over 80% of their transactions through their digital channels. And also, we looked at Stanbic Bank having invested over 50 billion in IT. What does this one mean? It means that in the near future, this is going to increase on their market share and also going to increase on their profitability. Then we went ahead and looked at strong competitive position and market share, whereby under this, we analyzed different metrics. The statistics for Stanbic Bank, they speak for themselves. Then we went ahead and looked at declining in profitability indicators, whereby we looked at return on equity and return on asset. And we are seeing that in 2020, because of COVID-19, there is a decline of 2.5 and 5.4% respectively. But we believe that Stanbic Bank in the near future, they are going to perform better and rectify some of these effects of COVID-19. Then we looked at investment in oil and gas, whereby Stanbic Bank is a partner, and they have agreed on an agreement with Zero, whereby Stanbic Bank actually has set aside over 70 million US dollars for companies that would wish to invest in oil and gas. And we believe that this, as we are saying that in Uganda, we are going to have the first drop of oil by 2025. We believe that by then, Stanbic Bank is going to gain profits, and also it is going to increase its market share. And this justifies our recommendation of hold. Let us go ahead with Jacinth, take us through an industry overview.
Thank you, Regan. Under industry overview, as a team, we looked at the general economic growth and realized that in 2021, the economy grew by 13.7%. This was mainly driven by the growth in the industry sector. We also analyzed the GDP growth rate, both region-wise and in Uganda. In region, we realized that Uganda is performing better than its peers. When you look at in Uganda here, we are seeing that it's increasing from 6.5% to 6.8%. And as a team, we anticipate that it will grow further to 7.2%, as you can see. We also looked at the inflation rates, the headline inflation rates. In East Africa, I see that Uganda is performing relatively well compared to its peers. Likewise, here in Uganda, in respect to the macroeconomic report released by Bank of Uganda in October, we saw the headline inflation rates reducing to 1.9% from a 6-month high of 2.2%. As a team, we also looked at the non-performing loan ratios in regards to the gross loans ratio, and we're seeing that in 2021, they increased from the 3.8% to 5.8%, mainly due to the closure of the businesses. Businesses were not in position to meet their loan obligations. This saw the industry credit risk also growing by the same percentages. We also looked at the private sector credit lending, whereby that Stanbic was able to give out 12.04 trillions in local currency loans, as well as 6.1 for foreign currency loans. As a team, we also looked at Stanbic's position in this industry, and we, based on Porter's 5 forces model, where we analyzed that Stanbic is facing high competition from the rivals as well as from substitutes. We also did a 5x4 matrix where we analyzed Stanbic, where we did a SWOT analysis of Stanbic in regards with those 5 forces of Porter, and realized that Stanbic reported high strength, low weaknesses, high opportunities as well as moderate threats, especially from the substitutes as well as the rivals. Thank you. Let's have Regan take us through the financial analysis.
Thank you so much, Jacinth. After we have looked at the industry overview, as a team also we analyzed the finances of Stanbic Bank using Camel's model that gave us a score of 1.8, which represents a satisfactory performance. We are going to look at 6 factors that we factored in to analyze the finances of Stanbic Bank. We looked at capital adequacy, whereby we analyzed that in 2020, Stanbic Bank posted a core and a total capital of 15.8 and 18.0% against the regulatories of Stanbic Bank, which is 10 and 12%. And we also need to remind ourselves that in effective 31st December 2021, the regulatories of Stanbic Bank were increased 12% and 14.5% respectively. And here, what does this one mean? It means that Stanbic Bank, having had a core and total capital adequacy above the regulatories of Bank of Uganda, we analyze that they are compliant to the regulatories of Bank of Uganda. And also it means that Stanbic Bank actually has enough capital buffers to absorb any losses that would occur along the way, minus actually destabilizing or threatening the stability of the institution. Then we went and looked at asset quality, whereby under asset quality we looked at credit loans ratio, whereby however much in 2020 we had effects of COVID-19, Stanbic Bank posted a higher ratio of 2.4% compared to what they had in 2019, which is 1.5, and what they had in 2018, which is 0.2. And we went ahead and looked at management quality, whereby management, Stanbic Bank in 2020, they demonstrated resilience in different metrics, and we did a comparison analysis with the peers, and we looked at Stanbic Bank performing better. And when we went ahead and looked at earnings quality, whereby we are seeing that Stanbic Bankers' profit, they are growing at 5% compounded annual growth rate. Then we went ahead and looked at liquidity, whereby under liquidity we looked at loan to deposit ratio, whereby Stanbic Bank, we are giving it a score of 1.1 because it was able to use the deposits from clients in order to generate profits for them. And we went ahead and we did sensitivity, where we are looking at how our price is affected by different risks that we are facing. Let us have Priscilla take us through valuation.
Thank you, Regan. As a team, we did our valuation on 10th December 2021, whereby we came up with a target price of 28.36. We came up with a target price of 28.36 with a closing price against the closing price of 26.0 with an upside of 9.08%. We used different valuation models, whereby we did the absolute valuation. We did the dividend discount model, whereby we came up with a target price of 27.76 with the H model and the Gordon model. We took the H model because it looks at the inconsistency in the period in which dividends are paid out and the rate at which they are paid out. We also further looked at the residue income model, whereby we got a target price of 29.84. We further looked at relative valuation, whereby we did the price to earning multiple and the price to book multiple. The price to earning multiple gave us a target price of 33.36, whereby we looked at the peers average, whereby we got the peers of Stanbic Bank, and we got an average of...
Your time is up. Your time is up.
Just wind up. It's okay, just continue. Just wind up.
Yeah, then we got a 6.69 peers average and 5.21 for Stanbic, which shows that Stanbic has been performing comparatively well. We also did the historical price to earning, where we realized that Stanbic has been posting a lower price to earning across the years, which shows that it has been performing relatively well compared to its peers. We also looked at the peers across the continent, and we got a peers average of 5.332 and SBU 5.21. We also did the price to book and came up with the target price of 20.87, looking at the price to book only, and also the return on equity and payout ratio, which gave us 30.752. We weighted our valuation models. The absolute valuation models got 35%. The relative valuation models got 15%, and they gave us a fair price of 28.36 against the closing price of 26.0, which shows us that however much Stanbic's share price is not currently performing so well, we anticipate that according to the drivers that we looked at, it is going to perform well in the coming years, which shows that they should hold. Thank you. Let me call upon Samson to take us through the risk analysis.
Thank you so much, Priscilla. As a team, we also looked at the risk analysis where we saw the various risks that are deterring SBU from attaining its target price of 28.36 Ugandan shillings. We assessed credit risks, operational risks, market risks, and compliance risks, and did a risk matrix where we looked at the likelihood of these risks vis-a-vis their impact on SBU and found out that they are in support of our recommendation 100%. We also did a Monte Carlo simulation where we ascertained the impact of these risks on the prices of SBU as per the period 4th January 2021 to 10th December 2021, and came up that a hold constituted 70%, a buy 20%, a sell 10%. We as a team, a sensitivity analysis was also conducted where we looked at how our target price is being impacted by the variables we factor in, and that is the cost of equity that stands at 21.3% and the growth in dividends that stands at 12.3%, and found out that they all linked our target price of 28.36 Ugandan shillings, and we see that a hold takes a big percentage. We also, in a nutshell, as a team, we offer a hold recommendation with a target price of 28.36 Ugandan shillings, showing an upside of 9.08%, basing on the key drivers that my colleague has clearly explained as he was starting. Thank you so much for listening. We call upon for your questions, if there is any.
Okay, thank you very much, Timon. That was a very passionate presentation you made, and it shows that you really took time on this presentation. So, kudos. Thank you very much for that, which I think was a very good presentation. Thank you. Really take time on that. What I wanted to ask about is what was one of your maybe one of the factors you looked at, which perhaps you needed to just convince me more about, was you said there was declining profitability, but I think you didn't do enough justice to show. Maybe I missed that, but of course with the holds, and you're expecting a higher price in the future. So there's declining profitability, and then but you expect that there will be a turnaround. So I think I didn't get enough of your assumptions on that turnaround. You did well with the metrics and everything, but just that thing. Could you just explain that?
Okay, thank you so much. Why we are saying a declining profitability, we are basing on statistics of 2020, whereby we are seeing that, I think because of COVID-19 effects, we are seeing that Stanbic Bank, in terms of return on equity, and return on assets, which are some of the profitability indicators that we based on to analyze the finances of Stanbic Bank, we are seeing that they had a decline, because in 2020 they had 20.5% in terms of return on equity, and in 2019 they had 25%, which actually showed a decline. And we believe, as I mentioned in my presentation, that Stanbic Bank, we believe in them, in their management, that they are going to come up with measures to curb some of these effects that led them to decline a bit, and it was because of COVID-19. I thank you.
Yes, thank you for that presentation. You mentioned that the digitalization strategy that the bank has and the 50 billion that has been invested in IT is a critical strength of Stanbic. How does that compare with the rest of the peers in the market, given that they most likely are having the same key drives? How does that compare, and is that a reason for someone to hold the share?
Yes, thank you. The massive digitalization that Stanbic is doing currently, yes, other banks are also doing massive digitalization, but if we realize Stanbic is doing more and more massive digitalization than the other banks are doing, because we realize that there is FlexiPay, there is FinTech, they're going more into the digital, and they're moving closer to their customers, which implies that they're going to gain more profitability, because the fact that they're moving closer to their customers is a way of getting closer to their markets. So in such a way, they're going to be able to reap out more benefits. They're doing more of the marketing, because we have very many FlexiPay merchants across, but I realize that anyone can easily access, which I have not seen being done by other banks, because I've not seen ABSA anywhere. I've not seen. Yes, they're doing the digitalization, but Stanbic has done much more. And why we say that they should hold, it's a driver to the holding, is because it's going to return much profits in the future, and the share price is going to perform better than it is performing currently.
Okay, just help me break it down to how the digitalization aids in bringing back the ROE decline that my colleague mentioned. Help me relate them.
Thank you so much. We see Stanbic Bank transferring 80% of their transactions onto digital channels, and how it is bringing about the reduction in the rate of return on equity and rate of return on assets. It's because in this kind of situation where we've been in a lockdown, many workers of the SBU have been working from home, and this one has exposed SBU to some of the various risks, such as fraud, such as cyber-related attacks. And this one has led to a reduction in their profitability. Thank you. As some of the direct indicators that we've talked about.
Maybe to add on what he has said, as how digitalization is going to help to improve on the declining return on equity. Realize that when you're doing things in the office, you're using paper and all that, realize that there is a lot of money you're spending in stationery, which that is money you're not going to spend it when you're doing digital. That means that is some of the income that Stanbic Bank has been losing because they have been incurring costs in line with providing stationery and some other things which we cannot incur when we are using digital platforms, I think.
Thank you very much. Thank you for the presentation. I guess I have two questions. The first one, you talked about investment in oil and gas. And I recall there's a figure you mentioned, if I get it wrong, $70 million.
70 million US dollars for a single company.
To the best of my knowledge, the oil and gas sector, the projections for investments are about $10 billion. So if Stanbic is going to have $70 million out of 10 billion, I don't know what that percentage is, but it's something small. To what extent is that going to, to what extent did you factor the growth of oil and gas in Stanbic's projections? It was given the size of the market and what piece of the market Stanbic will be able to get. That is one. That's one. I'll link the second question. The second one, currently in the markets in finance and going all over the world, there's a growth in what they call ESG. You aware of ESG? ESG, and you've even seen with the oil and gas pipeline and the refinery, you've been seeing some environmental people who have been, making some noise around ESG. Well, I did not see you bring any, in your presentation, how ESG, because ESG is one of the growing trends in the world. A lot of funding is going into ESG. So there are data providers that provide ESG, right? I have not seen how you've been able to incorporate ESG in your analysis, and yet it's one of the growing areas that is driving where funds are going. Thank you.
Thank you so much. I talked of 70 million US dollars. Stanbic Bank, that is for a single company, but Stanbic Bank is willing to offer between 15 to 20 billion dollars for the companies, but 70 million is for a single company that is willing to invest in oil and gas. And we believe that now, if they invest 15 to 20 billion in the near future, by 2025, where we anticipate maybe to get our first drop of oil as Uganda, we believe that it is going to bring in returns. And then when we go to ESG, we realize that however much, yes, we know that Western countries actually are against fossil oil and gas, but we believe that as Uganda, we are going to come up with environment-friendly way of doing things. That maybe we are going to reduce on the way we are, maybe if as a country, we are drilling, let's say, 100 times a year, maybe we are going to reduce on the way on the number that we are going to be drilling. And we believe that this is going to protect the environment. I thank you.
A supplement, when we talk about the ESG, Stanbic Bank is undertaking into corporate social responsibility, where it is putting at the forefront the principles of ESG. And this one, it is through corporate social responsibility, where it has partnered with Vivo Energy, NEMA, and Nile Breweries to protect the environment. And they protect the environment with a theme, let's protect the environment, that has been running. Thank you so much.
Okay, I just have one further question. Based on your financial analysis, I think you covered the company and the competitors well, but you didn't give a general overview of the banking industry in Uganda. So I think that's an area you left out. Maybe you can do it now. Then regarding valuation, I saw that one of the methodologies you indicated there, you mentioned RI. If you could explain that further. Yeah, and then lastly, I think I had a question in relation to ESG, just like you had mentioned, but you've covered that from the previous chat. Yeah.
Okay, thank you. You talked about the banking sector concentration. Sorry, maybe we left that out because of time. But when it comes to banking sector concentration, I think that
Not concentration, the general, overview of the banking sector.
Oh.
How is it performing?
it is performing relatively well, and we saw that the net assets increased to 862.2 billion in 2021 compared to 775.1 billion in 2020. Then when the concentration, we are seeing that the commercial banks are taking up 95.6%, and Stanbic is part of the domestically systemically important banks. This is a group of 5 banks that yes, there are more than 24, but mainly the 5, if they are not there, literally we would be going to other alternatives. And these include Standard Chartered, ABSA, DFCU, Bank of Baroda, I think, then even Stanbic. Thank you for answering that.
Thank you. You asked about the residue income model, which was the RI. Now, the residue income model, we look at the cash flows of Stanbic after removing the equity charge. Now, the equity charge is whereby you look at the cost of equity, whereby we calculated it using the capital asset pricing model, and we got the equity charge, which we lessed from the profits to come up with the cash flows. Now, those cash flows, they give us the economic profits and the accounting profits. The economic profits, they represent those profits that it shows that Stanbic, that different areas that it is investing in, they are returning as much. Then the accounting profits, it just shows us that some of the investments that Stanbic is investing in, some of the areas that Stanbic is investing in are not returning so much. And we calculated that in some years, realized that Stanbic got some accounting profits rather than economic profits. Thank you.
I think that's it from us.
Thank you so much.
All project officer, good morning. This is team 2. I'm Jim January, husband Hamble, Abadiana, and Simon Rock. We issued by recommendation for Stanbic Uganda Holdings Limited at a share price of 2.05, an upside of 24.61% from our last close of 25.72 Uganda shillings, and this is because of our investment in oil and gas, strong subsidiaries, as well as digital transformation. Stanbic has partnered with a consortium of 5 firms to invest collectively up to 52 million. Also, provide financial services through Stanbic Uganda Limited, as well as research on housing needs through Stanbic Properties. Stanbic has also seen an increase in loans and advances over the years, and this has seen a CAGR of 23%, as well as the holdings in government securities, which saw Stanbic acquire an award of being the best performer in the government securities market, implying that Stanbic undertakes profitable investment opportunities. Stanbic has also led its peers in terms of assets as well as profits, which saw an industry share of 32% in profits. SPG Securities, a brokerage services subsidiary, has also participated as the lead broker in the MTN IPO, as well as Stanbic Properties, which is doing research in investment of oil and gas. And these subsidiaries will lead the rest in steering our share price to be achieved. Stanbic also has seen digital transactions increase year on year, seeing a 36.2% as at half year 2021. And this shows that Stanbic is actively involved in developing digital platforms such as FlexiPay and contactless cards. And this will see our target share price being achieved due to efficiency as well as increase in operations. Moving on to the business description.
To further support our recommendation, Stanbic Uganda Holdings Limited is well structured in such a way that Stanbic Bank Africa owns 80% of the shares and 20 minor shares. Stanbic has 5 subsidiaries, that is Stanbic Bank, SB Securities, FlyHub, Stanbic Business Incubator, and moving forward to upside key matrices, as at half year 2021, we see that total assets increased by 14.4%, that implies asset accumulation. Customer loans also increased by 9.8%, that implies interest earned. And finally, customer deposits increased by 9.5%, that implies more credit creation. Moving forward to industrial operations.
We looked at the industry in which Stanbic operates and realized that Stanbic Uganda has actually is projected to grow at a GDP of 5.5% baseline in 2022, and this is because of the recovery from the pandemic. Bank of Uganda also states that Uganda has had a low inflation for a long period of time, and this is evident in 2021, where major inflation rates decreased except EFU and core inflation. Customer gross loans, commercial bank gross loans, as well as holdings in government securities also increased, showing improvement in economic conditions, but due to the after effects of the pandemic, we saw non-performing loans increase as well as real estate prices, which showed increased risk as most of the collateral security comes from real estate property. The liquidity risk remained low because of the standing liquidity facility by the central bank, and this saw the cost of wholesale funding decline in both interbank money markets as well as swap markets. Furthermore, the capital and profitability of commercial supervised financial institutions also remains strong due to the restriction on dividend payment by the central bank. We use the Porter's model to assess the completion of standing and realize that competition from the domestic systematically important banks, as well as threat of new products like mobile money poses the highest impact. But despite all of this, Stanbic remained with a strong competitive advantage because of the strengths and opportunities such as affordability as well as oil and gas, and this will see after the share price being achieved since this implies a conducive environment and a competitive position which is strong. Moving on to financial analysis.
We used the Campbell's model to rate Stanbic's financial strength and got a 1.456 showing strong performance. Stanbic's capital position has remained stable despite increase in provisions. It has increased from half year 2020 to half year 2021 against a regulatory minimum of 12%. This shows that Stanbic has strong capital to absorb losses and reduce risks. We use the non-performing loan ratio and credit loss ratio to value Stanbic's asset quality. Non-performing loan ratio has had a declining trend over years and only increased in 2020 following the impact of COVID-19. It has since reduced in half year 2021, and this shows an increase in earnings. Credit loss ratio has also had a declining trend and only increased in 2020 due to an increase in impairment charges by SMEs, and as at half year 2021 it has decreased, and this shows strong customer quality portfolio. So profit after tax per employee has had an increasing trend over years, and it has only reduced by a small percentage in 2020, and this shows strong management capability. We use return on equity, return on assets, and cost to income to value earnings of Stanbic, and Stanbic has had fluctuating profitability ratios over years, and as at half year 2021, they have increased, and this shows the company's efficiency in managing its equity capital and sustaining profitability. In terms of their peers in Uganda and East Africa, Stanbic has had an impeccable performance via return on equity. Continuous involvement in digital platforms and digitization will see cost to income below a 50% hurdle. We use loan to deposit ratio to value Stanbic's liquidity, and this has been increasing over years against a risk appetite of greater than 80%, and this shows that Stanbic has strong liquidity. We use interest rate risk to value sensitivity to market risk, and Stanbic has had a stable banking book and trading book interest rate risk within their tolerance levels. Moving on to valuation.
We use both intrinsic and relative valuation methods to assess the value of the share of Stanbic. The two-stage model that looks at a short-term high growth rate as well as a long-run lower growth rate in dividends was used, and this is because Stanbic has undergone rapid expansion as we saw introduction of new subsidiaries, and this gave us a target price of 34.85. The golden growth model that looks at the future series of dividends growing at a constant rate was used to, and this gave us a target price of 36.52. The residual income model that looks at the present value of future dividends as well as book value per share was used to assess the economic profitability, and this gave us a target price of 34.79. Relative valuation models such as the price to book value as well as price to earnings were used simply because they help us analyze the position of Stanbic relative to the market, and price to book specifically was used because Stanbic has a significant amount of assets. This gave us 21.63, while we used the price to earnings, and this gave us 42.83. Moving on to the ESG.
In addition to our positive valuation, we see that Stanbic Uganda Holdings Limited has maintained and steered up good environmental practices through the decline in its environmental metrics. The paper consumption reduced by 29% due to the onset of digital agenda. Fuel consumption and carbon emissions also reduced significantly, and this as a result of the company focusing on the reduction on diesel consumption. And this shows that the holding company not only focuses on profits, but also on environmental safety. The holding company has also maintained strong relationships with the people, and this is seen through the programs such as the National Stanbic Championship, which has helped to impart skills in students countrywide. It has enhanced value proposition to its customers to digital lending, and also increase its investment in training its employees, and this has led to efficiency and productivity at work. Stanbic Uganda Holdings also ensures good governance practices, as this is seen through the separation of the board into the non-executive directors, executive directors, and the independent executive directors, and this ensures independence and unbiased decision-making. Furthermore, the holding company also has a strong board audit committee that ensures that it's auditing the internal auditors' work as well as liaising it with the external auditors to ensure efficient operations. The holding company has also motivated its employees and management through increased salary and efficiency. Moving on to our investment, despite our reasons to support our buy recommendation, we still believe that the holding company is prone to risk. A risk matrix was conducted to assess the likelihood and impact of risk on the holding company. We realized that there are two risks that could have great impact on the holding company, and these are the credit risk and operational risk. Furthermore, a Monte Carlo simulation was also conducted to simulate future prices of the holding company basing on our closing price of 25.72, which resulted into a target price of 32.02. Furthermore, we also conducted a sensitivity analysis on our target price, whereby Thank you. We also conducted a sensitivity analysis on our target price, considering the cost of equity and dividend per share. We analyzed that despite the fluctuations, our target price still remains above the closing price of 25.72 Ugandan shillings, confirming our buy. We stand strong and we conclude with our buy recommendation of 32.02 Ugandan shillings. Thank you.
Thank you. You can pat yourself on the back. I think you balanced your board pretty well. You covered most of the areas that you're looking for, and I think by the time your time ended, you had come to the final conclusion. So, great job. I just have a couple of questions. There's four things that I looked at. One was you had a reference to the Petroleum Authority and Abbey Trust, which I didn't quite understand why they were there, because I didn't quite see the relationship why you needed those two. Let me just give you the questions, then you can distribute the questions among yourselves and answer them. When you went to the Gordon's model is a good model. My interest was in how you get the G. What did you consider as your G, your growth? Like what rate did you use and how did you get that? Lastly is the carbon emissions that you had in the ESG. Where did you get your data? What was the source of your data for the carbon emissions? Where did you get the information from? Yeah, those are my questions. Thanks.
Okay, I recall you asked about the golden growth model, and we got a growth of 19%, and this was simulated from our forecasts, where we looked at, we forecasted the dividend growth from 2021, I mean our estimate here, to 2026, and we obtained another growth rate in dividends of 19%. We also used the bond yield plus approach to find our cost of equity, because it uses standard methods as well as objective interpretation. Then we can talk about carbon emissions.
About the carbon emissions, looking at our 2020 report of Stanbic Uganda Holdings Limited, we realized that here the company had reduced fuel consumption by 12.3%. And remember that if there is a reduction in fuel consumption, eventually there will be less carbon emission. Uganda being part of the Paris Climate Accord, The holding company also stands by this fact and tries very much to reduce on the fuel consumption. This has led to the carbon emissions significantly declining as seen above.
In addition, carbon emissions, last year 2020, 2021, October, November, Uganda is a member of the COP26, which is in line to keep a temperature global warming to 1.5 degrees Celsius. So Uganda is, Stanbic Bank is in line with that, since Stanbic Bank is within the territory of Uganda.
Thank you very much. I think your presentation had a very chronological flow to it and was easy to follow. Sorry, the mic was off. So I was just saying that the general comment is that your presentation was well presented. It looks professional and has a flow to it. You did also cover the industry well, but the banking sector is heavily regulated, so maybe in future that's an area that we probably would want to include. What are the changes? What are the proposed changes? And how does it impact on the industry overall? Then you also covered ESG well. You looked at the environmental and governance, but then I didn't see you cover the social aspect to it. So maybe you can give us a highlight of how you believe Stanbic is changing people's lives. So yeah, those are the two comments or questions that I have.
Okay, before she explains about that, I'm going to address the question our first judge asked about us, the first slide having our consortium. So we brought in that to show you how Stanbic is coming in, this whole story of oil and gas. It is in a consortium of having subsidiaries representing Stanbic, the holding company, that is the Stanbic Properties Limited, as well as Stanbic Bank Uganda. So Stanbic, through this consortium, is participating in the oil and gas. Yeah, then Diana, you can continue.
To answer the social responsibility of the holding company, we see this and from the experience of, for example, the pandemic, we saw that the holding company increased its corporate investment by 34.5% from the previous year. And these investments were used in programs such as the Stanbic Championship to instill knowledge and to promote knowledge in students countrywide. We saw that the holding company also enhanced customer value. And during this time, there was a pandemic and most of the customers were not able to reach out to the bank. Hence, they provided online lending, online account opening, which was more convenient to their customers. We also see that they increased spending on their employees. This was to the technical skills that were given to them, like to help them in their workplace, how they can manage their customers despite the pandemic, and how they can get more digital skills in order to create this convenience in the working place. We also,
in addition to that, Stanbic has carried out very many trainings for their workers so that they can be able to increase their skills, and also their employee community involvement has been increasing over years. And during the pandemic, they've also been participating in tree planting so that it can conserve the environment. Yeah.
In addition, statistics for employee community involvement, 800 employees of Stanbic volunteered during the pandemic to give back to society. Then, to conclude, Stanbic is the lead sponsor of Uganda Cup.
So, one last question. Okay, forget the numbers. How would you convince me to buy? Like, what's the convincing story for someone to buy shares in Stanbic?
Okay, if I may begin.
So imagine I don't know anything in relation to valuation and investing. So what will be compelling story are you going to tell me to invest in Stanbic rather than invest in maybe Baroda or TFC?
Yeah, first of all, I would let you know that looking at banks, because I believe everyone would know what a bank is, and looking at the statistics of the bank, we check for what is the best bank. For example, in terms of profits, anyone would see that Stanbic has had the highest number of assets as well as profits. And furthermore, to look at profits, you look at both accounting profitability and economic profitability. So I would let someone know that rather than looking at just the accounting profitability, we use the residual income model to assess the economic profitability, and we've been seeing positive increase in residual income. So I think the profit part, as well as looking at the fact that Stanbic is looking into digitization. You know, our world now is moving from the old age of using papers and everything is getting online. And we are seeing that Stanbic is leading in this sector of digitalization as presented in our slides, using the FlexiPay and the contactless cards. Contactless cards actually is something new that most of the banks haven't implemented yet. So this is a positive and a plus for Stanbic because that helps us carry out transactions on the go. The other day when I went to Shell, I realized that they actually accept Shell payments using FlexiPay. So Stanbic is, other than being the bank that we're looking at outside, it's going on to the people through our social investments, and as well as enabling people to carry out their transactions efficiently. That is through the digital platforms. I would be convinced, and that I believe would convince someone that Stanbic is better than the rest of the companies.
In addition to that, Stanbic is also participating in oil and gas, and this has been forecasted to increase in the next 5 years, to have profits in the next 5 years. So, because it is part of the consortium and also Stanbic Properties Limited, so those are two of their subsidiaries that are partnering in a consortium to take part in oil and gas, so which has been forecasted to earn profits in the future. So this also makes an investor buy our shares.
Okay, maybe if you could just move to your valuation slide and then present the first or the second. Probably the next slide is something else. Okay, the previous one. So this is the two-sector growth model.
Yeah.
And you're giving a sustainable, the long-term growth rate of 10%.
Yeah.
Right? When I look at the market, Uganda as a market, the country, our GDP has been averaging between, let's say, 5 and 7%. So I want to understand what basis you used, because that growth rate in the model has a very, very big driver on the price. Right? It's a double-edged sword. Because it will increase the top part and will reduce the lower part. So it hits it twice and it can push your valuation up. So I want to understand how you came about to a sustainable long-term growth rate of 10%. Let's walk me through that.
Yeah, so looking at our two-stage growth model, first of all, I say that we used it specifically because Stanbic has undergone rapid expansion. And what do I mean by rapid expansion? In a period of 1 year, Stanbic has added up to 4 subsidiaries, and these are all promising subsidiaries. If the fact is that they were introduced during 2020 when they were in the pandemic, and this affected their start, but they are promising subsidiaries. That gives us the 17%. And other than looking at the figure, what does it mean realistically? We are seeing that the profits are going to increase rapidly because of the subsidiaries. And the lower long-run growth rate was also arrived at looking at 17%, and realized that the Stanbic cannot continue growing at 17% for the long run. So we simulated and proposed a long-run growth rate of 10% down from 17%, and we believe that that's enough given the strong subsidiaries that have come in a period of 1 year, meaning rapid expansion, as well as the fact that Stanbic cannot, first of all, outgrow the economy, and cannot have that 17% that looks actually to everyone as very big, but this is because of the subsidiaries. There are many, and they are all promising and profitable. Like we say, Stanbic Properties is undertaking research in the Albertine region, Fly Hub is looking at fintech, that is financial technologies, and that is the way to go in the future. As well as SBG Securities, we saw that it was the lead broker in the MTN IPO. So as well as Stanbic Bank, which first of all leads the group and also leads in terms of the peers. So this is enough to prove to us that all the subsidiaries of Stanbic affirm the growth rates given, because there are very many, and we believe that as the economy recovers, like we said in our industry overview, they are going to pick up, and this will actually help us affirm our growth rate of 17%, which will reduce or decline to a lower long-run growth rate, and this is a growth rate in dividends of 10%.
Thank you for that. One of your reasons for advising a buy is the subsidiary strength, and you repeated it a number of times. My question is, seeing that the most important thing in valuation is how to relate the price to the actual value of the company. Now, going forward, how do you, currently, which of the subsidiaries do you think is best poised to contribute to the holding company's revenue, and to what extent is that subsidiary set to contribute majorly? Because most of the numbers that we're seeing here are actually Stanbic Bank. Yes. So I want you to just give me a view on how SPG Securities, the property side, and the fintech are set to contribute, because the incubator hub is not going to bring after revenue. And that's one. Two, you mentioned in your slides that over the period that you're looking at, the loans are actually registering a growth. However, the credit loss ratio is going down, right? That's what you mentioned. Help me give an explanation as to why the credit loss ratio is going down for Stanbic Bank, and yet across the banking sector, the NPL ratios are actually going up.
So, okay, starting with the first question, could you please remind me a little bit? Sorry about that.
So, I want you to relate the price, yes, that the bank that you've given, because the price is forward-looking, and how the subsidiaries are contributing to that, but from a revenue angle, because you cannot possibly do the breakdown just from a revenue angle, and what perspective and why you believe that those subsidiaries are going to contribute that much value in revenue to contribute to your price.
Yeah, okay, looking at that, first of all, when you look at the business segments of Stanbic Bank, what's the holding company? Most of the segments, that is treasury capital, personal and business banking, as well as the corporate banking, show and signify that Stanbic is holding the company. And in their report actually says Stanbic is the anchor of the whole holding company. This basically shows the fact that Stanbic is the leader in terms of revenue. So the rest of the subsidiaries are following in line, as the profits are collected from Stanbic and other profitable subsidiaries are reverted back to the weaker subsidiaries to help the whole holding company to develop and grow. So I believe that the revenue from Stanbic actually is going to help us achieve our share price, coupled with the SPG Securities, because it's also undertaking brokerage services as well as other financial services.
So you're discounting the contribution of the other subsidiaries?
No, I'm saying that Stanbic's contribution is highlighted, but it doesn't mean that the rest of the subsidiaries are not performing to our expectations. I repeated and said that these subsidiaries were introduced in 2020, and this is a period where the pandemic was blooming. So that means you could not expect the subsidiaries abnormally, except Stanbic, that was using online platforms to continue transacting. But for example, Stanbic Incubator and also Stanbic Properties, that is real estate, most of those had declining profits during the pandemic, which affected everything else. So I believe that Stanbic, SPG Securities and Stanbic Properties, which is now also involved in oil and gas, are going to lead the rest of the subsidiaries, not undermining their contribution, but they are going to lead them as these ones follow. So I believe that answers that question.
Also, onto that, those subsidiaries were making profits in 2020, but then as at half year 2021, they have all started picking up and have started making profits. So since they started in 2020, and as at half year, they started making profits already. Sorry, they started making profits already. So that shows that in the unforeseen future, they will also be contributing to the bigger profits of Stanbic Uganda Holdings Limited.
Yeah, then could you please remind us of the second question?
My second question relates to the fact that you show that there is, over the period, the loans issued by Stanbic Bank are actually registering a growth. However, you're seeing a decline in the credit loss ratio, and yet the wider banking sector is actually harnessing higher NPLs at the moment. So what is contributing to the decline in the non-performing loans, and yet Stanbic is actually, according to your presentation, Stanbic is actually giving out more loans over the period?
Okay, first of all, you say according to our slide, Stanbic is registering loan growth, which is true, and that is evident because at half year there were 3.9 trillion loans compared to 3.2 at full year 2020. The non-performing loans basically actually increased in 2020 and 2021. And why was this the case? It was because most of the businesses generally, Stanbic is not outside of the whole global environment. We saw that there was the pandemic and generally business was low. And for example, despite the fact that loans are increasing, but people are not working, so they cannot pay back the loans. That's what led to the increase in non-performing loans. But we projected that non-performing loans are going to fall down. Why is this? Because the economy is recovering. We all see that the economy has been opened up. Businesses are borrowing more to recover, supported by also the central bank rate, which we saw being reduced to help businesses acquire loans at cheaper interest rates. So this shows that businesses are going to make profits, and therefore they'll be able to pay back the loans. Because their failure to make profits in the pandemic led to the increase in non-performing loans.
All right, thank you for your time and for your submission.
Yeah, that's it.
That's it. Thank you.
observed. This is Team 3. I'm Julian Easter.
Rwanda Francisco.
We are presenting to you Stanbic Uganda Holdings, and based on our analysis, we issue a buy recommendation at a 1-year target price of 30.77 Uganda shillings and upside of 18.35 from the last close of 26 Uganda shillings as at 3rd December 2021. The base for our recommendation is the profit and revenue growth, digitization, investment in oil and gas sector, and corporate restructuring. We shall go one by one. Profit and revenue growth. SBU's profit and revenue have grown at a compounded annual growth rate of 10.06% and 8.74% respectively from 2018 to 2021. And looking at ROA and ROE in comparison to the industry, we realize that SBU has a strong position, and this gives investors a positive signal that it is efficient in generating profits. Digitization. Stanbic has embraced digitization through FlexPay, online account opening, and agent banking, whereby 89% of the transactions are outside the branches, and this in turn increases the customer base and reduces the operational costs. Investment in the oil and gas sector. Stanbic is one of the partners taking part in the oil and gas sector, a game changer for Uganda's economy. And with the completion of the final investment decision, we expect its future returns to increase as trips from this sector. And therefore, this should give confidence to the present investors. Corporate restructuring. After restructuring, SUHL diversified its revenue streams with 5 subsidiaries. And therefore, as these subsidiaries grow, we expect its earnings to grow. For example, Stanbic Properties Limited posted a profit of 2.7 million by June 2021, and SBG was the main broker in the MTN IPO. Investing in Stanbic will therefore give you nothing other than incredible returns.
The business description. Stanbic Uganda Holdings, formerly known as Stanbic Bank Uganda, is a financial services company regulated by the Capital Markets Authority and is listed on the Uganda Securities Exchange with 5 subsidiaries, Stanbic Bank being its anchor subsidiary, SBG Securities, FlyHub, Stanbic Properties, and Stanbic Incubator Limited, and with Stanbic Africa Holdings being its majority shareholder. It has a high market penetration with a high branch concentration, and it operates through personal and business banking, corporate and investment banking, treasury, and capital management. It remains a market leader, basing on the profit after tax, loans and advances, customer deposits, and at its asset share. It generates revenue through net interest income and non-interest income.
Looking at the macroeconomic trends, Uganda's GDP grew at 2.9% in 2020, less than 6.8% recorded in 2019 due to the pandemic. But with partial opening of the economy in the second quarter of 2021, the GDP grew sharply by 13.7%, and therefore we expect it to grow subsequently as the economy recovers. And in comparison to the East African region, Uganda still had the high GDP in 2020. To support economic recovery, the Bank of Uganda reduced the central bank rate 6.5% in August 2021 to stimulate private sector lending, and the Ugandan shilling strengthened against the dollar in August 2021, posting a mid-average rate of 3,537, boosting returns on banks' assets. The inflation rates in 2021 also remained favorable compared to 2020, and the lending rates continued to drop as private sector recovers. And therefore, we conclude that Stanbic Uganda Holdings operates in an environment that is favorable for growth. Looking at the banking sector, the East African region banking sector remained resilient despite the pandemic, with growing assets and strong capital buffers. And the Ugandan banking sector is part of the services sector that is the major contributor to Uganda's GDP and is dominated by commercial banks. It has also continued to grow, as shown by the growing profitability, loans and advances, customer deposits, and strong capital buffers. However, the non-performing loan ratio is still a risk, but we expect it to drop as the economy recovers. And therefore, it is viable to invest in such a sector. We went ahead and conducted a 5-forces model to assess the competitiveness of Stanbic Uganda Holdings and found out that its major emphasis should be on the competitive rivalry and the slate of substitute products. And on conducting the SWOT analysis, we concluded that its strengths and opportunities outweigh the weaknesses and threats, which is in line with our recommendation.
on conducting a financial analysis, we found out that SBU has a strong financial position with a Camel score of 1.46, and considering the capital adequacy, SBU is highly capitalized with strong capital buffers that are above the regulatory minimum and within their risk appetite, which indicates its ability to absorb losses. And in comparison with the industry, SBU still has a strong capital adequacy. Looking at asset quality, we consider the non-performing and credit loan ratios, and we found out that there is a favorable trend in both ratios, which are within their limits, and which indicates its adequacy in covering credit losses. Looking at management quality, we consider the assets, deposits from customers, net interest income, and loans from customers. And we found out that SBU is the market leader in comparison with the industry, which indicates its ability to manage financial stress. Looking at earnings quality, we consider the return on equity and return on assets, which showed us a stable trend, indicating its efficiency in generating earnings, and in comparison with the industry, SBU is the market leader in terms of return on equity. Looking at the liquidity position of SBU, consider the loan-to-deposit ratio, and we found out that it has a favorable trend within their risk appetite of greater than 80%, indicating its ability to honor the short-term obligations. Moving on to valuation of SBU, we valued SBU using absolute and relative valuation, attaching weights of 60 and 40% respectively, giving us a target price of 30.77 shillings, an upside of 18.35% on the last close of 26 shillings on 3rd December 2021. For absolute valuation, we consider the dividend discount model because it focuses on the intrinsic value of a firm. We used a cost of equity of 21.8, for which we calculated using the Kappa model, a beta value of 0.63, which we calculated using a regression analysis of SBU share price against the all share index on the USE. And we used the risk-free rate of a 10-year government treasury bond because it is less risky. And we got a price of 33.41, indicating that SBU is undervalued. For relative valuation, we considered the peers within the East African region, and we conducted the price to earnings and the price to book multiple valuation, and we came up with a multiple 4.21 against the peers average of 5.25 for price to earnings, indicating that SBU was outperforming the market. In addition, we carried out a historical analysis of the price to earnings for SBU and realized a declining trend, indicating that SBU is outperforming the market and it's a buy. Looking at the price to book, we got a multiple of 0.84 above the peers average of 0.7, indicating that SBU is performing well. And in addition, we carried out a historical trend of our price to book, and we found out a declining trend, and this signifies that SBU is performing better and it's a buy.
Investors not only focus on the financial status but also on the non-financial status of the company, and this is illustrated by the environment, social impact. Environmentally, SBU has continued to support the environmental conservation programs through enhancing adequate use of infrastructures, tools and methods for environmental sustainability. And this has been indicated by its engagement in tree planting and training its employees on the environmental conservation practices. Socially, SBU has continued to support and uplift the community within which it operates through the corporate social investment and the employee community intervention, which is in line with this purpose statement of about transforming lives for a better Uganda. Basing on its corporate governance, there has been a separation between SUHL and the subsidiaries board, good succession planning, skills diversity, and gender diversity. Basing on the OECD principles, we give it a score of 75%, indicating good corporate governance practices.
In every investment decision, there are risks, and we found out the major risk affecting our buy recommendation is the operational risk, comprising of fraud and cyber risks. However, this can be mitigated through use of cyber security associated with artificial intelligence and other methods. We also carried out a Monte Carlo simulation, and we found out that our investor is still safe due to the low standard deviation. Moving on to the sensitivity analysis, we found that however much there is an increase or a decrease in the most important variables, that is dividend growth rate and cost of equity, the investor is still safe with a high buy potential. And with those few remarks, we stand strong with our buy recommendation. With a price of 30.77, an upside of 18.35% on the last close of 26 shillings on 3rd December 2021. With those strong points supporting our buy recommendation. Thank you.
My question is on your GDP growth number. If you don't mind going back to that chart. I believe you stated the GDP would grow at 22%. The 20%. So you stated that GDP investment in oil and gas would bring the GDP to grow by 22%, and that over the period from 2020 to 2021, we would have a GDP growth of 13.7%. I want you to just explain why you believe oil and gas would have an impact of up to that level, and what the historical number is, and then relate that to, if you really believe that 22% is an achievable number, why then in your DDM you actually put a sustainable growth rate of only 16%? Help me compare and contrast those two.
Okay, GDP will grow by 22% around 2026 because now we've seen oil and gas is a game changer in Uganda, and it is a fundamental in the economic growth. So, since now SBU has tried also to train the SMEs, we expect these SMEs to grow, and as they grow, they contribute to the GDP growth. And this is going to shoot that GDP at that level. And this SMEs comprise of these people who will prepare meals for these workers in the oil and gas sector. These people are going to provide transport. These people are going to provide the brains. And these people are major contributors to the GDP growth in the country. So we expect that by that time, the GDP will shoot at that. And for the dividends, you talked about the sustainable growth of 16%. Okay, you talked about the sustainable growth of 16%. Now SBU historically has been paying dividends, and its dividends have been growing year on year. And since SBU is a mature company, it is able to attain that growth rate. Yeah.
And to supplement his contribution, yes, he asked us that we have estimated the GDP to grow by 22%, and yet we are giving the growth in dividends at 16%. Definitely, we wouldn't give the dividend a growth that is above the country's growth, because the growth of the country's dividends will be in accordance to the in the company's dividends will not be higher than the country's growth.
Thank you very much. I just have, I think, one question. First of all, I'll compliment you that of all the presenters today, you're the first that has given a timeline to achieve the upside that you indicated in your report. So you're saying 12 months, yeah? So well done on that. Then my question is, in your very first slide, you had indicated that you had allocated 60% as a weight to the DDM and 40% to relative value. What was your reasoning behind that?
Okay, we allocated 60% for DDM because it caters for the intrinsic value of a firm. And DDM is used for a company that pays its dividends year on year. And we've seen Stanbic paying out its dividends year on year. Even when Bank of Uganda instructed the commercial banks to hold their dividends in order to maintain their capital buffers, still Stanbic had a dividend to pay out.
Thank you very much, Team 3. I think you finished within the allotted time, which was very good use of your time, balanced it. I also liked your use of the comparison of price to earnings ratio versus the industry to come up with the recommendation you made, which I think was appropriate. The issue that my colleagues have had, that I've also had, was the your estimates. For instance, GDP is a macro figure, and you're looking at GDP, you're considering it's a formula. You've got government expenditure, the difference between exports, imports. That's what, you know the full formula I hope, for GDP. That then gives you your estimate. So basically, when you explain the GDP, it's going to be explained as imports, exports. Maybe oil is more than your imports are now more, your exports are maybe greater, stuff like that. Yeah, but that's for you to think about. Now, my question is on the risk-free rate you're using here of 15.51%. Is that for 1 year paper, 1 year treasury bills, or?
It is for a 10-year treasury bond because it is less risky.
Okay, horizon is 1 year. So just looking at comparison. And then your G of 16 was also a kind of, because if you look at the economic growth now, that's really high up there. So I was just looking at how you get your G, because it's a big factor here, the growth. That's my last question, if you can just answer.
Okay, like I said, that Stanbic Uganda Holdings is a mature company, and it has been paying out its dividends year on year. And when we calculated its compounded annual growth rate for the last years in terms of dividends, we got that 16%, and we used it for our sustainable growth rate. Since now, however much it is a mature company, it has restructured, and these new subsidiaries, we expect them to bring in more profits, and they will be in position to pay out the dividends. And more so, we expect the economy to recover by the end of 2022, since the central bank rate has reduced the interest rate to 6.5 to support that. So as the economy recovers, we know this GDP is going to shoot high, since even in the half year, due to the partial opening, it shot to 13 from 2.9. So there is that high expectation that it will reach there.
Yes, mine is a simple question. Okay, it's fine. Mine is a simple question. In relation to the ESG, I think I also saw the social and governance perspective. Did you touch the environment as well? Because I don't remember seeing that. Just take it away.
Just flip there.
Environmentally, Stanbic has engaged in tree planting, and there has been even a reduction in its paper consumption by a percentage of 29%, which shows that there will be a reduction in waste. And there is also a reduction in fuel, which will reduce energy consumption, which will reduce pollution. And in terms of reduction in energy consumption, they have resorted to the use of the hydroelectric power, which is known as clean energy. Then, another point for environmental, Stanbic has also trained its employees on the environmental conservation practices.
Right, thank you very much for the presentation. There was good use of your time. What I've noticed, I think, besides, except for the question that people asked, at least you handled your top-down approach. You looked from the global economy, you tried to come into the industry of the company, and that was a good approach. I don't know, one of the areas that I think you could also look at to improve is in terms of regulation. You know, something is a bank regulated by the commercial bank, and every June, the commercial bank releases a report, the financial sustainability report, which gives a broad overview of the banking sector. So I think going forward, you should also look into that report and try and draw, some issues from the central bank, because that would be very important
given that they are under a regulated environment. Otherwise, there is representation.
Good afternoon, everyone. Team 4 initiated a coverage on Stanbic Uganda Holdings Limited, of which the results concluded a target price of 32.05 Uganda shillings. That stamps our buy recommendation with an upside of 28.2% from the last close of 25 shillings on January 14, 2022. Our decision is supported by 3 pillars, namely SBU's strategic reorganization, its steady growth in net interest income, and its unique positioning in Uganda's oil and gas sector. Now, SBU has come a long way from its inception in 1906 as the National Bank of India, and after a host of identity changes, in 2002 it acquired majority shareholding of Uganda Commercial Bank. After listing on the stock exchange in 2007, it then reorganized itself in 2018 to better invest in the Ugandan economy. Now as a holding company, it's involved in banking, property management, business incubation, capital markets, and also financial technology. It's no surprise that Uganda's largest bank has the widest coverage, with the largest amount of agents, ATMs, branches, and customers. The banking subsidiary contributes the largest proportion of the group's revenue and is divided into 3 main segments, which are the business and commercial clients, the consumer and high net worth segment, and last but not least, the wholesale segment, which is the cash cow, contributing over 50% in net interest income over the last year. Ismail, why should we invest in SBU?
Thank you very much, John. We believe the market has underestimated SBU's strategic organization potential. Historically, SBU has maintained its top position in the banking sector with the banking sector and gain potential to tap into other various sectors. Stanbic Bank has contributed 15.5% growth in net interest income, as well as FlyHub contributing 28.2% growth in comprehensive income of Stanbic Holding Uganda Limited. FlyHub has onboarded 87% of its clients onto the various digital platforms of the holding company, hence enhancing company value through cost reduction and diversified revenues. Steady growth in net interest income. This is mainly driven by the 20.1 growth in corporate loans and the declining lending rates, making borrowing from Stanbic cheaper to its clients. This is further expected to accelerate the growth in net loans and advances, coupled with the declining non-performing loans in its loan book, which is further expected to improve the asset quality, profitability, and the value of SBU. Strategic unique positioning in the oil and gas sector. SBU is well positioned to tap into the various involvements in the oil and gas sector. This is mainly through providing project finance, advisory services, and training the SMEs to participate in the initially valued $3.5 billion crude oil project, currently valued at 10 billion US dollars. So through this, Stanbic Bank is expected to exploit 60% of the debt finance of this project, approximating to around 3.5 billion. So with this, we expect Stanbic to enhance its value through diversifying its revenues, got from the participation in this sector. I call upon Judith to give the industry.
Thank you, Ismail. Under industry, the GDP grew less than expected, from 6.8% to 2.9% as a result of the impact of COVID-19, which saw a sharp contraction in business activities. However, we anticipate that the GDP will increase to 3.9% following the reopening of the economy. SBU is in a better position to recover its revenues. In a bid to reduce the impact of COVID-19, the central bank introduced a number of monetary policy actions that saw the central bank rate reduced from 9% to 7%, leading to a decline in the remaining lending rates. SBU is in a better position to exploit this opportunity, and it became the lowest lender in the market. In 2020, we registered a decline in the private sector credit growth. The growth varied from sector to sector, and this was a result of a decline in the shilling lending and also the strict credit standards. However, SBU took opportunity in this, and it remained the strongest contributor in the various sectors. Under competitive positioning, SBU is a market leader by assets, customer deposits, and it has a high operating efficiency. It is a market leader in net loans and advances to customers. We assessed SBU's competitive positioning using the Porter's 5 forces, and we concluded that it is not threatened by new entrants due to the restrictive capital requirements to join the industry. However, it is threatened by a high threat of substitutes and a high bargaining power of consumers due to the high penetrative power of other financial service providers. Monica, how sustainable is SBU?
Thank you, Judith. We assessed the sustainability of SBU, and we saw that SBU is highly committed towards achieving its sustainability goals through integrating SEE, ESG in line with the SDG goals. And as we can see, it has promoted environmental conservation through the reduction in carbon footprint and electricity consumption. Socially, as we can see, SBU has invested in various social projects, for example, the training of 60 and above students, paying their school fees and tuition, then contributing 200 billion Uganda shillings towards the COVID-19 relief in a way of supporting the health sector. And we also assessed the governance of SBU, whereby we used the 100 score looking at the board of directors' experience, their responsibilities to shareholders, executive compensation, responsibility to stakeholders, and transparency, whereby we came with a score of 85.3%, which was a very good one. On the side of gender composition, we saw SBU moving towards a balanced gender, as shown by the percentage of female representatives on the executive and board of directors. Leon, take us through the financial analysis.
Thank you, Monica. Our assessment of SBU's financial health shows it to be in great shape. It posted 20% return on average equity, which was double the industry average last year. On top of that, its profitability looks good, having a 6.04% CAGR in profits after tax, and its earnings per share finally hitting the 5 shilling mark in 2001. It's also had a very attractive PE ratio that's one of the best in the market. It's also enjoying the benefits of positive jaws from their efficiency as they have dropped their CTI ratio below 48%. Historically, SBU's foundation has always been its strong asset and customer base, and it has been able to maintain its regulatory capital above regulatory limits, even with the Basel III amendments. Its asset quality is also pristine, maintaining the loan-to-deposit ratio above 60%, while stifling non-performing loans under 6% even during COVID times. It's also well covered in terms of liquidity, posting 12.4x liquidity coverage in 2021 and having interest earning assets to total assets at 80%. Now, how did we value SBU, Isaac?
Thank you very much. And we valued as SBU basing on a weighted average that led us to a target price of 32.05 Ugandan shillings, weighting DDM with 40, residual income 40, and comparables model 20. Our DDM suggests an upside of up to 38.88 Ugandan shillings, considering our cost of equity that we got using the capital asset pricing model and the terminal growth rate at 10%. Our residual income model led us to a 28.08 Ugandan shillings target price, using the same cost of equity and the terminal growth rate, this time 3.2%, following the estimated growth in the GDP. So we made our comparables model based on the PE and the PPV ratio of Stanbic Bank in relation to other banks in Uganda, East Africa, and Africa. Further, we made a regression analysis, and SBU happens to fall under the regression line, meaning it is undervalued, hence further supporting our recommendation. In our risk analysis, we found DDM sensitive to terminal growth rate. However, it would require over 4% change in our terminal growth rate to influence our recommendation. We also made a risk matrix that identifies only two major risks, that is the pandemic risk and the cyber risk.
Just summarize. 1 minute.
Therefore, following the strategic reorganization of this company, the steady growth in net interest income, and the unique positioning in the oil and gas sector, we issue a buy recommendation with a target price of 32.05 Ugandan shillings, presenting a 28.2% upside. Thank you very much.
Thank you for your presentation. It's well prepared, looks very professional. Well done with that. I just have a question in relation to if you go to your ECG coverage, you mentioned that yeah, go back. Yeah, that slide. That Ministry of Health had received 200 billion in as COVID relief. Is that correct figure? I don't remember ever coming across, and it seems to be too big, much bigger than the profitability of the bank. Profit after tax, right?
Yes, close to profit after tax.
Yes. Okay. Yeah, just need clarity on that. And then your cost of equity, you place it at, let's go there. So your cost of equity is at 15%, and yet that would probably be what your risk-free rate would be here in Uganda, unless maybe you are valuing it based on dollars. Then I would be convinced that that's a correct figure. Maybe you could just explain to us how you actually arrived to it. You know.
If you could just answer those questions first, and then we'll ask another round.
So, firstly, the 200 billion figure, I believe, was a typo. It was an error. It shouldn't be that large because it's almost the same amount as the profit after tax from the last 2 years. So, I think that one was just an error in the compilation of the report. It's 200 million, not 200.
200 million?
Yes.
Okay.
For the cost of equity, we used the market return. We used a proxy of the return on equity, which is 20.5%. Then we used the beta. We calculated it from the all share index and also the historical prices of Stanbic, and then we came up with a beta of 0.06. Then for we used a treasury bond of 15.2%, to come up with that figure of cost of equity with 15.55%.
Okay. I have one question. First of all, nice presentation, looks nice. Also the flow is pretty good. I just have one question for Ismail. Ismail, in the middle of your presentation, you said a figure, 3.5 billion.
That was the initial value of the East African crude oil project. But currently it's valued at 10 billion.
10 billion?
Yes.
And then you said 3.5 billion.
That I said initially.
Initially?
Yes.
Okay, so when you say that didn't relate with what you are presenting, you seem to be, I've internalized it and you just said it out.
No, it was initial value.
Okay, so how does this then fit into your buy recommendation?
Okay. The project is valued. Actually, the project is said to be valued to be financed 60% by debt, and of which the 60% of the debt that's going to be contributed, Stanbic is well positioned to provide the 3.5 billion of the 60%, which is approximately $1.5.
That's in dollars, 3.5.
Yes, $billion.
But you know they have you know that there's a concept. It is what's it called? They are concession. There is a group of lenders, and Stanbic is one of those group of lenders. So it's not just Stanbic Bank per se giving the $3.5 billion, but it's a group of other funders that include Stanbic. Yeah.
Yeah, and also we expect this company, with the help of the parent company, Standard Bank, to be able to exploit the 60% that is meant to be financed to this project using debt. So we expect it using the parent company to actually exploit this opportunity.
Okay. Thank you for your presentation. I just have one question. What was your focus period? What was your focus period into the future?
Our focus period was 5 years from 2021 to 2025.
And basing on that, you stated that the net interest income has been growing. Yes. Did you happen to take a view on the actual net interest margins and whether they were growing or they were being reduced, or they were reducing?
Yes, we did, and we saw.
Let me go this way. There's a lot of NIM compression going around on the larger banks that are more exposed to international markets. This NIM compression reduces the amount, the size of the NIM, the margin, and because of other things like the inflation and then also being in a hyper-competitive market, this is bound to happen. So as much as we project in the 5-year growth and a very high increase in these kinds of, in the comprehensive income and in the net interest income, we do see that, however, there will be some sort of limit that will have to be reached when the central bank decides to become more aggressive with their monetary policy and increase interest rates. Stanbic will still be in a difficult position because it has to keep its prime rate low to benefit from economies of scale lending to such a large base, beating its customers. However, it also has the choice of wanting to have profits. Now with NIM compression, it can't really do this. That's why our forecasts, as much as they are for a 5-year period, the target price will not vary so much due to the negating effects of NIM compression on the growth in net interest income.
Thank you for your presentation. And please, we do not have any further questions.
Thank you.
Dear judges, ladies and gentlemen, good afternoon.
Good afternoon.
Before you is Team 5, and it comprises of Kenneth, Joshua, Emma, and I, Cynthia. Today, we strongly issue a buy recommendation for Stanbic Bank Uganda with a 12-month target price of 34 Ugandan shillings, representing an upside of 47.8%, looking at the close of 31st December 2020, that closed off with a price of 23 Ugandan shillings. Our investment decision is greatly backed up by three key drivers as represented on the graph. We have the strong financial health of the bank, we have the strong competitive positioning of Stanbic, and the potential upside in the promising outlook of the Ugandan economy. Stanbic Bank, which we today issue a buy recommendation for, traces its origin in Uganda as the National Bank of India in 1906, and after several name changes has evolved to become Stanbic Bank Uganda, which in 2019 restructured into a holdings company to include 4 additional subsidiaries. These include the Fly Hub, the Business Incubator, the Properties Limited, and the Securities Exchange. It has also been seen to evolve into a client-centric structure that incorporates the use of data, AI, client solutions, and platform enablers so as to cater for its high net worth clientele. Moving forward, we looked at the business model that Stanbic Bank uses. And worth noting is that the bank has 3 major banking units, that is the personal and business banking, the corporate and investment banking, and then the treasury and capital management, which as of 2020 represented or contributed to its 1.43 trillion Ugandan shillings as market cap. Worth noting is that Stanbic's track record of success is also attributed to its market-leading position in the corporate and investment banking as represented there. Over the last 2 years, our economy has been unstable due to the COVID-19 pandemic. Over to Joshua to take us through the domestic outlook.
The COVID-19 pandemic has had a negative effect on the global economy and subsequently the Ugandan economy. This can be seen by the decline in real GDP growth for the country, as well as the decline in Uganda's trade balance. It is also important to note that this had a negative impact on the banking sector. However, on the bright side, Stanbic Bank Uganda was able to remain adequately capitalized and stay afloat in spite of the hardship. The full reopening of the economy with key sectors like tourism, entertainment and education, as well as the signing of the final investment decision, signifying a commitment by companies such as Total Energies to invest in the excess of $10 billion into the development of the oil and gas sector, presents numerous opportunities for growth of the Uganda's economy, as well as Stanbic Bank.
In addition, the performance of the banking industry is also worth attributing to our investment decision. Over the last year, 2020, Bank of Uganda issued a statement that showed that the total assets of the banking industry were increasing by a percentage of 16.8%, which is way afloat for us as a bank, as we stand at 8.8 trillion shillings as of our total assets. When we come to the capital adequacy of the banking industry, the banking industry has remained adequately capitalized with 20.6 and 22.5% as its total core and industry core. Well, we all know that funding and liquidity are very important for a bank's operation. The customer deposits of the banking sector in Uganda have been registered to increase by 17.1%, showing that Stanbic Bank alone, currently, as of 2020, has a share of 5.7 trillion shillings attributed to its customer deposits. A strong competitive positioning is very important for our company to be your investment decision today. We use the Porter's 5 forces analysis and the SWOT analysis, and as we can all see, the threat of substitutes is the only highly emergent factor which as a company is mitigating through its digital innovation. Looking at the opportunities, we would like to concentrate on the oil and gas industry, which is targeting Stanbic Bank as its go-to bank. Ken will come and take us through the financial analysis of Stanbic Bank.
Getting into the financial health of Stanbic Bank Uganda Limited, we were able to use the CAMELS analysis that gave us a score of 1.5 with reference to the different parameters that are set by the Basel III. Moving forward, we were able to look at capital adequacy of Stanbic Bank Uganda Limited. What we looked at under the capital adequacy was based on key drivers such as the core capital, total capital against the risk-weighted assets. And we got to realize that by 2020, it registered 18%, which was 8 points above the industrial average, that is that has been set in place by the regulatory bodies at 10%, giving it the industrial average. And also, as at 2021 half-year report, it showed an increase. This shows us that Stanbic Bank has invested heavily in its core capital so as to protect the different depositors in terms of losses at any point in time. Moving forward, we looked at its asset quality. And under asset quality, we looked at credit loss ratio and the non-performing loans. We get to realize that the credit ratio of Stanbic Bank rose from 1.5% to 2.4%, which showed a decline in its asset quality. But this was brought about by the slight slump during the economic crisis of 2020. But this was provided for by the increase in the non-performing loans as provisions, and that was at 110%. We get to realize that it was able to look at its different assets so as to keep in the different business models as of today.
In addition to that, beyond our asset quality, we're able to achieve quite a number of milestones thanks to our key drivers, that is a strong client centricity, employee engagement, prudent risk management team. For example, we were able to achieve the 154.9 billion net profit with an increase of 21.5%. Moving forward, as you can see, we registered an increase in our return on equity from 20.5% to 23.2% as illustrated over there, which enabled us to have an increasing trend in our dividends over the past 5 years, regardless of the fall that was noted in 2020. Over to you, Ken.
In addition to the sound earnings, as she has noted, we basically looked at how viable Stanbic Bank is able to maintain in business, and we get to realize that the continuing increase in the earnings from different assets and different equities, we get to realize that it is able to expand in different portfolios so as to continue in business. Moving forward, we also looked at its liquidity. And we got to realize that the liquidity of Stanbic Bank has been recorded under 80% over the past 5 years. And this shows us that Stanbic Bank has been able to remain highly liquid compared to its different peers. This is simply because of the increase in the loans and advances that have increased over the past year, and also the increase in customer deposits over the time. We went ahead to look at Stanbic Bank against its different peers, and we used different drivers such as profit after tax, loans and advances, the total assets, and the peers market cap. And we get to realize that under all different factors, Stanbic Bank gets to stand ahead of its different peers. And we get to realize that Stanbic Bank has a potential so as to be the best bank, so as to...
With that said, we're able to value our company using two specific valuation models, that is the dividend discount model and the price per book value. As we all know, these are renowned models used for valuing companies, and in our case, specifically banks that issue out dividends. Moving forward, we're able to register an upside of 47.8%, and this was backed up by the 80% close to accuracy of the dividend discount model. This is because it uses dividends that are usually constant over long periods of time, unlike the price per book value, which is usually subject to market changes. Moving forward, we can see that SBU has tried to maintain a constant increase in its dividend pay. However, that dropped in 2020, but we can see under the 2021 half-year reports that they tried to rise back to 2019 before the pandemic, which gives us actually hope with the now open economy that with time things are going to stabilize, and with that our dividend pays will be increasing with time. That's our stronghold for the buy recommendation. Over to you, Joshua, for the risk.
The credit risk, market risk, liquidity risk, as well as the operational risk, among others, are all possible factors that could deter Stanbic Bank from attaining its target price. For example, as a result of the effect of the pandemic on business activity, the credit risk was heightened in 2020, as explained by my peer, with the increase in credit loss ratio from 1.5 the previous year to 2.4. The operational risk is also driven.
You can summarize, finish up.
The operational risk is also greatly driven by the threat of cyber insecurity as a result of a good number of the bank's activities being online. On the bright side, however, the bank has in place mitigants to safeguard it against the negative impacts of this risk. Looking at the operational risk and putting it into context, the bank has in place methods such as ensuring double-factor authentication, as well as investing in artificial intelligence in order to safeguard it against the threat of cyber insecurity. Looking at the corporate governance structure of Stanbic Bank's leadership operates in compliance to regulations, legislation, and standards as stipulated by the governing body. Stanbic Bank's leadership is skilled, knowledgeable, and experienced both locally and internationally. As a result, the bank has been able to win numerous awards. For example, it was voted the best bank in Uganda in 2020 by Euromoney Awards, Global Finance Magazine, among others. Looking at Stanbic Bank through the lens of key ESG indicators, we are able to realize that the bank's corporate social investment spend has exhibited an increasing trend over the past 5 years, which is significant of their commitment to giving back to the communities in which they serve. Important to note is that a big portion of their corporate investment spend goes to education, which is in line with sustainable goal 4 of quality education. The bank's ratio of female employees to total employees has also oscillated about 50% over the past 5 years, which is also in line with SDG 5 of gender equity. This is the kind of bank you'd love to really be associated with as an investor.
And with that said, our dear judges, ladies and gentlemen, we issue a strong buy recommendation with a target price of 34 Ugandan shillings per share with an upside of 47.8%. Good afternoon.
Thank you for your presentation. Maybe just before I go into my questions, just a quick comment. Usually when you're having time for a presentation, like a slide, time in 10 minutes, should always come with what is it that I want to speak to my audience, right? You may have a slide with many things, but you don't have to explain everything in its very detail because you have limited time. So you're giving a very recommendation. What are the key things under valuation? And under the company analysis, just focus on the key drivers, the key issues, and then put them across so that you have better use of your time going forward. Now, my first question, when I looked into your valuation, the slide that you showed, I did not see you put through the inputs. I saw you put the methods. There was a DTM and a price to book value, if I remember well. But key to valuation are the inputs, because the inputs are the ones that will affect the price that you're given. What are the inputs that you put in the dividend discount model, for example? What are the inputs that you put to be able to arrive, right? That is very important because I would need to look at that and see how that drives into your valuation. So I think that's something that you need to work on going forward. The second one, also during evaluation, I did not see you do any sensitivity analysis, right? It's like you are making assumption that everything is going to reminding me of what the minister said, the economy is going to go this, and then COVID hits within a few years. So you need to incorporate sensitivity into your model so that you can be able to look at all considerations that you have. So that's I didn't have questions because of lack of information. So I thought I would just give you general feedback that you would have to improve. Thank you.
From my side, I would love to reiterate what you said, but also add on that I haven't seen a comparables view from your valuation, unless you have it somewhere, and you could maybe expand on that.
I have most of the details on my report, the report that is submitted. However, I could take you through a few of them if allowed time.
Thank you. Please do.
Yeah, go ahead.
So we were able to get the cost of equity using the capital asset pricing model, and that was at 20.19%, which helped us to calculate our target price under the DDA model, which gives us 34 Ugandan shillings a share. We also calculated a beta of 0.85, and we all know that the market stands at a threshold of 1, so it was performing 85% below the market. This enabled it to actually have a stand while it was falling, it did not fall completely as the market did during the fall, which gave it the room for a rise or recovery. Yes, and our price per book value, as you can see, we were able to get a 32.4, but we all know that price per book value is actually subject to very many changes in the market that may affect our costs, our capital. So with that, we didn't really value it that much. We took it at a 20% close to accuracy. That's our final for the DDM model because of the dividends that it holds, which are quite indisputable and are usually constant over long periods of time.
Okay, in your presentation you mentioned that you've given the DDM 80% of the price.
Yes, sir.
However, you did note the fluctuation in the dividends that Stanbic has been issuing over the focus over the period. You mentioned that too.
Yes, I did.
And you think you should have maybe gotten another model to supplement that because the dividends are not as sustainable enough to warrant an 80% weighting in your model?
Stanbic Bank has had quite volatile, Stanbic Bank stocks have been quite volatile in the market over the past years. However, as you can see, much as it has been quite volatile, they have tried to maintain payment of dividends and the increase over years. Much as it may not be really much, they have really tried to maintain it so that the investors are not worried about the mere fact that their stocks are actually quite volatile on the market.
I thank you for that, and I love how you are well dressed. You're I think the smartest at this point. Your ties are all in sync. Thank you.
Thanks. Generally, well done. I just wanted to see more on the ESG slide. I think I did see the social part of it. Just explain to me that part only, just that. Yeah.
So the ESG slide, we focused on lack of prepared social investment spend because, and we realize that it spends most of this into education. For example, in the Stanbic Schools Challenge, which is in line with SDG 4 of quality education, and also they are measuring well on the gender equality, which is also SDG 5. Yes.
Thanks. I think that's all I have. Yeah.
Thank you very
Thanks,
much.
guys.
Wow, thank you all for the morning session. I think it was pretty intense. I was trying to take some notes, then I realized halfway I'm not prepared. Because I was being reminded of models, dividend discount, I don't know, H model. What was the H model all about? I remember it has 2 periods, I don't know. You know what, let me leave the professionals to do the professional thing. So thank you for that session. I think we can see that the caliber of presentations is really high. The presentations were really nice. I enjoyed the delivery because I've not spent time to immerse myself in Stanbic. So over the last two hours, I've been relearning about Stanbic from your eyes and from your notes. So we're going to take a break. We're going to take a Ruth, how many minutes do we? 15 minutes. So we'll have a short break. We're going to have a tea break for those who haven't had an opportunity. We are going to give the judges a few minutes to tabulate. So in the meantime, we'll
take a short break as they tabulate, and then when we come back, we will reconvene here in 10 minutes plus some change, and we'll be able to receive our top 2 teams for the session. Then we'll again move back into the final round. I think I can use this time to share my thoughts on what I thought was important for the teams to think about. One, the first time you write an equity report, it's good to highlight that you're initiating coverage. The first time. So if you ever write a report about any listed company or any company at all, the first time you write a professional recommendation, it's important that you highlight that you initiate coverage with a buy or hold recommendation at a target price of X with a given horizon. Okay, that statement has to be very clear, such that if anything happens and your slides get off, that statement will remain solid, because that's the essence of the story you're going to tell us for the next 10-15 minutes. So it's important that that is the leading statement, that you are initiating coverage of Standard Bank Uganda Holdings with a buy, hold, sell recommendation and the target price. You can highlight the upside if it can add some value, and then give us a horizon. Are we looking at 6 months? Are we looking at 1 year? Because those mean different things. One of the things that also I've noted is that most of you did not speak to us about the current price. Where is it today? Are you still holding the same view you had in December, despite the change in price? All right? Because I think we've noted that the price has come down recently, about 3 to 4 shillings down, compared to where it was standing in December. So looking at your analysis, do you still hold the same view? Are you still holding a buy, a hold, or sell view, despite the changes in the last 2 months? It's important for you to always reflect current events in any discussion. We cannot pretend that we don't know that the current price has changed. So that has to be embedded also there. The last thing that I wanted also to highlight to you is that you need to quantify every statement and show its relationship to your recommendations. Whether you're talking about the business model, the value proposition, competitive positioning of the company you follow, you need to show with some quantitative numbers how this is going to influence either the balance sheet or the final valuation. It's not enough for us to know that the company is extensive in the oil and gas sector. Are they extending more credit to oil and gas? Is there a metric, a measure that you have applied to this to arrive at this view? So if Stanbic is positioning itself in oil and gas, have you seen a difference between 2018 and 2019 in terms of that sector? And can you put a figure to it? Can you show the proportion? Because that is what supports your view that oil and gas is becoming more important in their balance sheet. If you are talking about the macroeconomics, that you expect stability, you are looking at a GDP growth of 7%. What does that mean in terms of their balance sheet and P&L? Are you seeing an increase in mortgages? Are mortgages the largest segment within their business model? Are you seeing an increase in credit cards? Are credit cards becoming more? What is the contribution of credit cards to P&L? And are credit cards related to consumption, and consumption of what in the main economy? So if you're saying the economy is peaking at 7, the channel through which Stanbic will benefit could either be mortgages, could either be vehicle and asset, it could be credit cards. So you need to be very clear on how you see the translation between the macro to the balance sheet. This has to be very clear in your mind. And then finally, for me, in terms of presentation, when you are given a short time span to speak, it's not fatal for you not to follow your slides in order. It's not fatal. Because the time is too short, you want to speak to the key things. Okay? You want to speak to the key. That's why the first statement is very important. If the first statement is very clear on what you want to do, the next set of slides are justifications. They are just supports. You can miss one or two, but you identify the three things that you think support your view. That is how you fit the time allotted to you. Okay? If there is anything else that comes up, whether you judge this question, then you can reference your slides to support your answers. So I feel that those would be some key things that you should think about, especially those who are moving to the next round. But it's also important for those as key takeaway for all of us as we go back to reflect on the presentation we made today. So those were my early thoughts, and I wanted to share them before I forget, because when I take tea, usually it happens. Right. So thank you very much. So we can take a break. I think now we have 5 minutes left. I've eaten 5. Can I eat another 5? No, I'm flexible. I can take up another 5. Good.
You can eat.
Okay, let me eat another 5 minutes. Since people don't want tea. I didn't introduce myself, by the way, did I?
Working tea.
I didn't introduce. So we can do working tea. Yeah. Okay. Feel free to step out, get a cup of coffee, chocolate, and everything. Okay, let me take this over to introduce myself. I think I didn't do that well in the beginning. My names are Alan Luetabe. I'm a board member with CFA Society East Africa. I'm in a volunteer role because our society is made up and mostly run by volunteers. We have a very small team that runs our operations, but largely this is a volunteer role. My day-to-day job, I'm a head of investments at the Deposit Protection Fund, where I run a team of 4 people responsible for managing in a large amount of money. And I don't want to say anymore. Previously, I used to be an assistant director at the Bank of Uganda, where I was responsible again for a team that was managing the foreign reserves. And then before that, I was a portfolio manager running a US dollar portfolio in excess of about $400 million. So my last 8 years have really been around portfolio management, fund management. Before that, I actually worked for Stanbic Bank. And true story, I started as a teller. Though I didn't like it, but I started as a teller, and I rode through, learned some credit, sold some buses to some schools in Masaka. We bought some tractors for some farmers. That's how I learned credit. Later, I came into recoveries, chasing people in the hills of the Antonde and Zimbabwe, chasing people to repay loans. And I came to BOU as an examiner. So I started out in Bank of Uganda as a bank examiner, looking at a lot of this information again. Basel rules, camels. When I see camels, I get goosebumps. I didn't like that one. It was... So yes, so I have about, I think now, time has flown. I'm about to do 20 years in the industry, both on the commercial side and the front office side, where I manage money. And I believe that it's important for us to give back. Because when we started out, there was no one to talk to. We were making things up. Because there was no one in the industry who knew what needs to be done. So everything, and the internet wouldn't exist. It's unimaginable. There was no internet. So you either had to get a physical book or speak to somebody. Today we are happy that there is now more structure in how we introduce information at a very young level for you guys, such that things are not, You're not making it up as you go along. And the reason we run the research challenge is to be able to give you at a very high level an introduction to what capital markets is all about. And by using this opportunity, we are able to show you where the future could be for you. What kind of jobs can you do? So this allows you to clarify in your mind what is your likely journey. If you're a finance graduate or you are studying for finance, economic statistics, the business courses, where can you go and what does it mean? This was not available even 5 years ago, but we are happy that it's the Capital Markets Authority, industry players are also taking it seriously. One of the things that, just to put the pressure on for the teams now that are going to the next round, we are looking to identify a junior analyst who will be working with one of our partners from today's exercise. We are looking for a junior analyst out of this exercise today who is going to join one of our partners. So as I'm highlighting to you, this exercise is very serious. The industry is taking it seriously because, as you can see, this is an interview in itself. The quality of questions you are getting is not what you get in your usual university, Q&As. These are industry professionals asking you very difficult questions. And you are showcasing your skills to somebody in this audience who is looking at you and marking off, and at the end of the day, they are going to be selecting one person to join their team as a junior analyst. So it's very important that we take this seriously. We are taking it seriously on our side, but we want you as the future of this industry to take it and pay attention to it. So as I close, I want to urge you all to continue with this journey. If you need additional information on what you need to learn, career guidance, how to improve your presentation skills, how to improve your PowerPoints and all those stories, please, you can approach us, approach the judges after the sessions. They'll be able to to engage with you and show you some of the key tips that you need to have. We are always looking for Ruth, what is the word? Volunteers. We are always looking for volunteers within the society. Please, if you are interested to work with the CFA Society, you can let Ruth know. She will take your details down and we'll be able to get in touch. As and when we have functions like these, you'll be invited to participate. We do have other functions. We have conferences, we have online webinars. We are planning a lot more events now that most economies are open. So we need more people to come on board and help us set up some of these events. And so if you are interested to work with the CFA Society, please reach out to Ruth and let her know she will maintain our database and she'll be able to engage with you on that. Allow me to stop here. Let me also go and take tea. So it's been a pleasure, and I'll see you in about 5 minutes. Thank you. You are still welcome to try the tea, by the way. Feel free. Thank you. Obugalo.
We are just going to take some time here and share our views. I think I'll start with Mr. Mutu, and then come to George, and finally my brother. Okay? Yeah, go for it. So, Mr. Mutu, what would be your favorite models for valuing Stanbic stock, and just some reasons why? Compare Stanbic and maybe Meme, and just walk us through what would be your thought process behind.
Thank you very much. So like we saw the different valuation models that many of the presenters we are putting forward for the evaluation of Stanbic. So before you go and do evaluation, it's important to understand this type of value, right? Because some of the drivers, for example, if you're using a dividend discounting model and you have an entity, let's say which is a growth stock, like we have growth and value stocks, right? So growth companies largely cannot pay dividends. You find that they have high growth projections, and many of them reinvest their cash flows to be able to grow, right? Like the tech companies. So you will not find them offering dividends, and that will be one of the drivers that you use in the right. When you look at companies like Stanbic would be considered to be a value stock. You look at the metrics like the dividend yields are high, and then also the price to earnings ratios tend to be lower. So because of that, you find that the dividend discounted model, and you can see a history of Stanbic paying dividends, which can be able to give you an expectation of a trend going into the future. So that would be one of the good measures of doing that. The second thing, you also look at in terms of Stanbic is a listed company, right? And we have peer banks also listed on the Uganda Stock Exchange. So it's easy to do a comparative analysis on things like the price to book and the price, and it's like you were able to do, right? Now, basing on that, then what will come is how, to what extent, let's say, do I apportion the what? Do I apportion what percentage would I give to, let's say the DDM versus the price of earnings, right? Now, what I would say, what would be like the biggest driver for value in the company, right? If I'm looking at Stanbic and I see that the biggest driver for their growth in value is coming more from dividends, I'm buying the stock in Stanbic, right? I'm not anticipating a lot of share price movement, but I am seeing that this is a company that's going to be able to pay me dividends sustainably over a long term, right? That would probably be my reason for giving a higher weight. Now, whether it will be 60, 70, or 80, I cannot say that there's a clear percentage that you should be able to put, but you have to have a sound basis behind why you have chosen 60, 70, and 80. And that's why when they would ask you, why did you have this? What matters is what from your research that you read about the company. Why have you chosen 60% and not 80 and not 70? Because at the end of the day, that will drive the price. Because when you weight out the price, if let's say the EDM gave you a very higher price, it's going to weigh the price to the side. And that will influence your decision, right? And then also largely when you've done evaluation, you also need to have a band within which, right? If a stock is valued at 26, and I get, let's say, 28 for my valuation, that doesn't necessarily mean it's a buy. Because remember, you're making assumptions in evaluation, right? So you may have a band that says, let's say, 26 plus or minus 4, for example. Let me give an example. So if it falls within this band, I may not recommend a buy or sell. And then once it goes over or under that band, that's when I will be able to recommend the buy, the sell, or the hold. Thank you very much.
Thank you so much, Mr. Daniel Mutu. He works at the Electricity Regulatory Authority, and you can tell that the rates you're paying in electricity are well computed. He's also CFA, so he's completed the 3 levels, and that takes quite some time. We have very few CFAs in Uganda. I'm going to move on to another CFA here next to me, Mr. George Otim, who's also SCCA CFA, and he works at BDO. No, actually, FCCA, you know.
FCCA.
FCCA? Oh, you're FCCA, you're a fellow.
No, let me correct. I finished SCC about 10 years ago, but I've not been paying my membership, so. so I just decided, well, you know what, yeah, because I did start off as working as an accountant, so I didn't see the need, but it's a decision that I probably regret, so I just started paying my dues actually this year, so it's better late than never.
So if there's anybody you're looking to speak to in regards to this professional qualifications, experience in the practice, here's someone you can speak to, and don't be afraid to approach any of these gentlemen here to just give you some leadership advice and guidance. But we're talking about Stanbic today. What are your thoughts generally on the stock, your personal views? And then if you could just relate that with how the groups did versus what you see.
Okay. Yeah, maybe after this I can just give you, it will be nice to share with the people in this room my story, and because I think 10 years ago when I was just about the age of the people who presented here, I don't think I would probably have been able to have the guts to come here and make a presentation. So you should give yourselves a round of applause. Yeah. I guess that will come a little bit later. Looking at it from the perspective of any business, let it be Stanbic or any other, the key question, before even you think about looking at the numbers, you need to understand generally this business, what is it about, what is its story, yeah? Before you consider looking at what's the valuation metric I'm going to use and all that stuff, all that comes later. So key question is, what is the story? What's so compelling about this business that's going to make me want to invest in it, right? So, for instance, from Stanbic's perspective, given its history, it's been around for quite a long time. It's probably one of the oldest banks in the market. It has gone under quite significant transformation over the years. Initially kicked off as a government entity, and then it was privatized. And through that privatization, it has gone through robust leadership. So all these things count, right? So you don't have to spend so much time juggling with all those numbers. It gets confusing at times, yeah? So once you do that and you've convinced yourself that, okay, based on the products that they are issuing, are they innovative, they're introducing, so most of the analysis goes into the SWOT and the 5 forces, Porter's 5 forces. So when you get to a point and you're convinced that this company has a competitive edge, then from there you would say, okay, fine. Yeah, this is something I want to invest in. Then before even you go into the valuation in itself, you need to understand what's its balance sheet. So in simple terms, a balance sheet is, you're looking at the providers of capital of the business. So think of it, you want to start up your own chapati store and start making Rolexes, right? So who are the people who are going to put money into that business? It's going to be you as a shareholder, and you're doing it expecting that this business is going to generate me returns, correct? Yeah, so the business owes you money in that sense, right? Then in the event your capital is not adequate enough, then you would probably approach a bank to get you extra capital, right? Then given those two, you're going to now take that money and invest into the assets of the business. So the balance sheet will just give you that summary, and then you say, okay, fine, does it have a strong balance sheet? And in your normal perspective is, you don't want to borrow heavily, given the uncertainty of any business you're going to be involved in, and end up failing to meet your obligations, right? So your debt levels have to be a little bit limited, right? So ideally the business should be sustainable in the sense that it generates enough cash for it to continue, right? But from a perspective of a bank, now debt is a raw material, yeah? Because
banks ideally take, it's just a system to efficiently allocate capital, right? So they take your deposits, they'll also probably borrow at lower rates, and they'll also issue you maybe some returns on the deposits you have with them, then take that money and invest it, right? So they invest it in government bonds and then lend out to people who need that money at a higher rate, right? So that's generally the main way that they would probably be earning their income. So you need to understand the business model in itself, right? So once you do that, you've analyzed the balance sheet, then you can now come and look at how is it doing in terms of profitability. So how revenue, is the revenue growing? Yes or no? If it's growing, then what are the drivers of that revenue? Is the company, does it keep on expanding its customer base, or does it have the same customer base but keeps on coming up with different products to facilitate its growth, right? Then look at how it's managing its costs. So you have to pay attention to things like the cost to income ratio, what are its profitability versus its peers. So once you get the level of comfort that, oh fine, this is actually a strong business, and especially in times of COVID, the key item you'd want to pay attention to is the amount of cash it has, right? Because there's a lot of uncertainty associated with businesses operating here, so you would want to know, okay, this business has this much cash, yeah? In the event they're not able to issue out any new loans, is this company, is the bank going to be able to sustain its operations versus its historical costs, yeah? Now when you get again that level of comfort, you now go into the valuation process, and Mutu has given a very robust answer on how to go about it, but it's important also to look at the nature of the business. Now banks, like I said, borrow and lend, right? So most of its assets from an accounting perspective are all going to be a reflection of its fair value, right? So if that's the case, then that gives you an indication that actually this bank is trading at its fair value. If I get the assets less its liability, this is what the equity value is, right? Then you will probably want to compare it with how other banks are also performing, look at the returns. I saw you spent time doing the analysis of the comparable companies, KCB, etc., and getting the average. You can go ahead and get the average, but it's also important to look at the metrics of those competitors and say, okay, the average, let's say, price to book multiple is 0.8, yeah? The return on assets and the return on equity on these of these banks are probably 25, 15, 16, to be quite a range. But now Stanbic is giving you a return on equity of about, let's say, 20%, yeah? So of these comparables that I'm looking at, which one is also probably giving me the same return? Because remember, you're taking money out of your pocket to invest in Stanbic. Why wouldn't you invest in that same company, right? Then it's like, I think Dixon mentioned that it's neither science nor is it an art, but I think it's a mix of two. Because we're all going to look at the different methodologies, but like you've seen, everyone ended up with a different price, and yet you considered all these valuation methodologies. The whole point is, once you're getting to your valuation, can you back it up and give a compelling reason for someone to buy into your company? So generally, sorry, it's been long, but that's the thought process that everyone should have.
Thank you very much, George. Yeah, George gave a fairly lengthy answer because he's really passionate about this this business. You can tell he's really invested in the knowledge of it and the professional side of it. And we're saying all these things to you because we expect that from here, with your experience being part of this challenge, you are now going to be motivated to approach any of these investment houses, investment banks that are doing this, and actually begin to, this should be the start of you going to approach a Stanbic Bank or a Standard Bank or a UAP Financial Services and ask for, follow-on experience, maybe as an intern or maybe a better position, and say you have actually taken part in some valuation exercise and continue from there. And in future, maybe you own your own investment bank or investment house. So we really think this is like applicable to you. Dixon gave some information that we have very few people involved in valuation, and so you can be a very good part of a very good cohort that can actually. There is ready money, people to pay you for doing this, and if you can begin your business, think of valuing it, and that will help Uganda, to help yourself, to help us go forward. Which brings me to our next speaker, Mr. Bukomeko Godfrey. He's been where you are, in your shoes, so he's perhaps, when it comes to this challenge, one of the most experienced of us here. He's going to give us his overview of how we've grown over time, from when he took part and what he's seen over the years, and then your views on Stanbic and whether we have done it justice. Do you think the participants have really dissected this stock suitably? Mr. Bukomeko.
Yes, I don't know where to start from. I will first crack a joke from my neighbor here, George. After the first presentation, as we were trying to ask the question, he whispers, don't be too harsh. They're just students. However, my journey started from actually participating in the challenge back in university. And then at some point I was an industry mentor. At the point where Uganda and Kenya were tussling it out in Nairobi, and we couldn't tell who was better than the other. I was one of the key industry mentors of that team, and I felt that we were actually far better than the team that we lost to at the time. Now, the society has done a tremendous job making sure that the quality of the slides, the experience of the student, and the maturity that they gain participating in the challenge grows over time. I can assure you, I walk on the street and I find so many former challenge participants, and they tell me, you know what, actually the challenge being on my resume helped me get into KPMG, helped me get into PwC, and they actually want to come back and appreciate the challenge, appreciate the society. But I guess the only people that they easily get to find are Ruth and their various mentors. If any of you has any friends who are in a lower year in university, please take the initiative to actually encourage them to participate so that we can have, say, 15 to 20 teams next time, so that knowledge will not only help you in your career, but you giving back and encouraging the younger ones who are definitely younger than you. You're still young, but they're younger than you. It will help them to, hearing from you will help them to appreciate, and then their experience will actually get to help you later on. Now, about Stanbic Bank, I want to give a story. I'm a former banker myself. I was a product controller in Stanbic Bank at the time. Currently, I'm an investment consultant and a serial entrepreneur. Have you done justice to the valuation of Stanbic Bank? At the risk of giving you eye openers for your next presentation, I would say that the reference to the price in valuation is oftentimes not in line with the value of the actual company. So the task that you are trying to execute here is you're trying to state whether the current price reflects the value. Now, I am going to look at it from the value side and not from the current price. So most of the presentations that were done looked at Stanbic Bank in isolation and not at the general strategy of Stanbic Holdings. The value that SBU holds currently in the market is mostly embedded within the future performance of the subsidiaries. They are well positioned, and the shareholder is well capitalized to actually take key market opportunities in. Now,
I'm going to corner it from one example. All of you know that yes, there is going to be a 10 billion inflow from oil and gas. And of course, that is the key narrative as when speaking to the growth in revenue of Stanbic Bank. However, when it comes to the holdings company, the reason why in 2020 they actually brought on board 4 new subsidiaries, it was particularly to position the holding company to get a lot more from the 10 billion than say a $300-400 million income. And if you're trying to value Stanbic Bank alone, you're right to give very low reference to the actual revenue coming due to oil and gas. But when you're looking at the holdings company, you need to look at the comparable holding companies in economies like Ghana, Nigeria, where oil and gas not so long ago, about 20-30 years ago, they started to actually drill and sell to the international market the crude oil. The companies that positioned in the segments that Stanbic Holdings is actually positioning, how did they perform? And then you could get to derive a far more indicative value from there and tell us how the share price will be impacted due to the value that would come from that. On the second part, the financial analysis of the bank. Most of you mentioned the business model, PPP, the CIB, and all these others. However, in the financials, you did not reflect on how sustainable these different business units were contributing to the Stanbic revenue. Yes, I did ask only one team about the NIMs, and that was particularly because I figured that they had mentioned some terms like JAWS, and I thought they understood what it was. But every time when you're looking at the financial analysis of the company, you have to look at the relevant ratios that you need to look at, how their trend affects the performance of the business, and then be able to justify the growth numbers that you give the business. I believe that aspect was not as comprehensive as it should have been. I don't want to take any further time, but it's those two, how you relate the oil and gas to the value, and then how you actually get to assess the individual business units and relate that to the actual value of the company. And then the relation between value and price that has been reiterated by my 2 colleagues earlier. Thank you.
Thank you very much, judges. Do we have any additional remarks?
Yeah.
Judges.
So, like I said, I'll just give you a little bit of background of how I've got myself here. So, I finished my A-levels in 2009, then signed up to do SCCA in 2010. In 2010, I finished in 2012, then I was lucky to join a very small, let's say, boutique. It was the smallest, like a startup in this market, so we were only 2 employees at that time, and it was a learning process for me. So in my very first meeting, I remember I was in a boardroom with the MD of NSSF and quite robust analysts I'd never seen before. Like everything was totally new, yeah. So I didn't get, of course, I had, in theory, I had captured some of these concepts through my studies in SCCA, but when I got to that boardroom, I was like, whoa, okay. So this is how these guys discuss this stuff. But then my confidence levels were not at the highest. It's not like I didn't have an idea, but I was just impressed and timid at that point. But then you have young people, I believe probably right now you're 21 or just thereabout. But trust me, when I was 21, I don't think I would have had the courage to stand up here on this stage and make this presentation. So if you told me today to invest among your peers, yeah, and say if I had, let's say, 10 million Ugandan shillings, I'm doing a DCF on how much you're going to probably earn in the next 10 years, and you're with others who have not participated in this research challenge, trust me, I would invest in you. So shoot. Yeah. And those are the soft skills that actually propel you throughout your entire career. I got to learn this through the hard way, by being thrown into the deep end, and then you have to, of the swimming pool, and have to swim. Yeah, you either swim or drown. So, which was a good experience for me. So that's how I got here. So I finished SCCA, then worked for I&M Babbage Capital for about 8 years, and then recently joined BDO East Africa, and currently head their corporate finance. So I've been able to work on a couple of deals in the market. But all these, I can tell you, comes with experience and networking with the right people. The people I started my SCCA journey with, we are still friends. We have done SCCA, we did SCCA together, we did CFA together. Most of us have completed, and I think one will probably complete very soon. But the whole point is, if you don't network and meet the right people, your chances of succeeding in life are quite limited. Yeah? So kudos to yourselves. Really pleased and happy for everyone who has participated in this, and the sky is the limit. Keep getting better and better. Of course, this being the first time, you might have made a couple of errors here and there, but nevertheless, that's how we learn and that's how we get better. But
thank you very much.
Yes, just 2 remarks. You are free to refer to me as BG, then I'll know that you know me. If you refer to me as Godfrey, I will think you're trying to vibe me. What you experienced through the CFA will impact your life depending on what you do after the experience. So you could walk out of here today and maybe you are team number 5 and think that you're a failure, or you could walk out of here today and carry the learnings and actually take the initiative to begin to network, call Alan, call me, call George, and then also enroll into the challenge. Once you do that, your next steps will actually give you the fruits that you will then look back on 5 years later, and stand up and say that I'm happy I actually did participate in the challenge. So what you do after here will determine whether you make a gain or a loss from your experience. Please take that and keep it in mind.
Thank you, BK. Oh, BG.
You almost got me there. I also want to make a remark. I always tell people this. I remember at the time when I finished my senior 6, I had gotten an opportunity to study my Bachelor's of Commerce at MOOBS. I was on government sponsorship. But my dad chose to send me abroad to study. And I asked him, why are you spending all this money when I have a scholarship? Then he asked me one thing. He asked me, Daniel, do you know why money is valuable? And I'm like, no. And he told me, because it's scarce. Anything that everybody has is not valuable, right? And that is one thing that drove me. Just like George, when I finished university, I did SCCA, did CFA, I'm now doing my master's. But one thing I noticed is that whenever you do something that is valuable, you become, that is scarce, you become valuable. We have been in interviews whereby you just sit back at the call and you know what, this is a headhunt, we want you to come and be interviewed. Like Alan was saying, where you apply to URA, I did application to URA. At that time, when I finished university, we were 15,000 applicants, and they wanted 100 people. So you ask yourself, do you want to go through that journey, or do you want to reach a point whereby they say, okay, like they said, we want research people who can do valuations. People are very few in the market. So if I say I want a valuation expert, just a handful of people. If I say I want a CFA charter holder, in the country we are like about 40. So you find that we are very scarce. So, because currently me and Alan and Zach, we are teaching CFA as well. So we would like to encourage some of you guys, given that you've gotten a feel of this, right? Right after university, enroll when you're still young. Study some of these courses.
I remember when we began CFA in my class, we were 13 people, right? Many of us were not working in the investment industry. As I speak today, none of us is not working in the industry. We have, some of us are finished, others are in the final level, but none of us is not working. Why? Because we chose a path that will differentiate us from everyone and would not be competing with everyone for these, these mundane, jobs that anybody can do. So I encourage you guys, take advantage of what an exposure earlier when you're still young. Some people get to know about these things when they're much older. Take advantage of that. And like they said, like the way you do valuation, you're discounting future cash flows to get your value right now. Even you as an individual, you can value yourself. You can project and discount your future cash flows. If I get the right knowledge and everything, then you'll be able to have a higher valuation. Thank you very much.
Well, thank you so much, judges. Special thanks to CFA Daniel Mutu, DG, Georgia team, GO, CFA. I hope you've been inspired by our judges and they have shared from their heart, very passionate. I can't emphasize more how you should actually begin to the CFA very early. There's actually somebody who only did CFA, didn't do a bachelor's, didn't do anything else, just did CFA and got into business. And they actually started African Alliance here back then. So the fellow just did his CFA and began to fly the world over. Colin will come to Hong Kong, talks, goes to Uganda, began an investment bank, then traveled to South Africa. So just having just CFA can just open for you global doors. So it's really something you should think about doing. In Kenya, university students over there thinking their CFA journey very early while they're about university there. So it should be something that should be an eye-opener for you. Final word of encouragement is we're going to have someone come first, and there will be someone coming last, but don't take it too personally, and don't take it as don't get too bitter. I finished campus with a first-class degree, but there were times when I was in school, for instance, that I, of course, went streams, and I once got the lowest mark in the physics exam, and I was shocked. I'm like, how? Everyone had this above mark, and I was like, what? And it was a monthly test. But you see, I bounced back from that and did better with my life. So regardless of how you score here, don't take it too personally. You can always bounce back. Like, you have endless possibilities ahead of you. But we thank you all. We've enjoyed the first session. We think everyone really put in effort. And we've been talking about the quality of presentations. It's gone up. We are now at the highest quality we've ever had. And so, guys, thank you very much. I think this session is going to end here. And let's give the judges a round of applause. Over to you, Alan.
Wow, thank you guys for your career advice. I think for the team here, for the participants, this is, while it was not really original on the agenda, I think you guys have picked something, one or two things that will be useful. We've been advised by the hotel that we need to have lunch now. Ruth, is lunch ready? We're going to go for lunch. Let's use 45 minutes for lunch so that we can come back and finish the last session. Hopefully we can finish by 3:30. I'll be announcing the teams after lunch. Okay? So let's all agree our lunch time. We are not under pressure. Okay, thank you. Okay, let's break for lunch quickly. All right, let's go.
Yeah.
Oh. Ruth, one of our judges has a meeting at 3:30. Can we do the two teams in 45 minutes or less? We can, I think, minus the Q&A.
Yeah.
Right? Oh. Oh, but pressure is back. But no pressure. A little pressure, but no pressure. Okay, we are delighted to announce our advancing teams. It's been a grueling morning experience for some of you, but we need to progress and select our winner for today. Team 2 is advancing to the next stage. And Team 4 is also advancing. Judges, these are our 2 finalists for today. We thank the rest of the teams for their efforts and for making this exercise awesome today. We're going to request the 2 teams to move to the holding area, and then we'll invite them back to start the presentations. Yeah, it's the same presentation. So on the feedback,
can we
same slide.
Slides.
Yeah.
Okay, what do we change? Do we change the presentation 35?
It's in 10 minutes, but not Q&A.
No Q&A.
Just a presentation.
Okay. This one has no Q&A.
No, it's not Q&A. Ruth, let us know when the teams are ready. So for this session, the teams will only be making a presentation. There will be no Q&A. Because we have already done a Q&A in the morning, we will focus mostly on listening to their presentation, and then the judges will grade accordingly. And after that, we'll be able to do the final scores. And then have our final winner for today. Good. Right.
So it has best. So I got like a banana 10%. So I just got it, kept quiet. Sugar.
Yep. Go. Protocol staff, good afternoon. This is Team 2. We issued by recommendation on Stanbic Uganda Holdings Limited at a target price of 2.05 and upside of 24.61% from our last close of 25.72 Uganda shillings. This is because of investment in oil and gas, strong subsidiaries, as well as digital transformation. Stanbic has partnered in a consortium of 5 firms to invest up to 350 million. Spidon's financial services through Stanbic Uganda Limited, as well as investing in housing, research on housing through Stanbic properties. Furthermore, the loans and advances grew year on year to CAGR of 23%. This saw investment in holding of government securities also increase. Therefore, this implies that Stanbic invests in profitable business ventures. Looking at digital transactions, as Stanbic has digital transactions have improved year on year, and this saw as a target 2021, 36.2% in terms of digital transactions. This is because of Stanbic's active involvement in developing digital platforms such as FlexiPay as well as contactless cards. Stanbic is the leader both in the group as well as the peers, and this has seen an industry share of profits of 32%. SBG Securities also takes part. I took part as the lead broker in the MTN IPO, as well as Stanbic Properties, which is taking part in research on housing needs in the investing of oil and gas. Furthermore, we move on to the business description.
To further support our recommendation, Stanbic Uganda Holdings Limited is owned by Stanbic Bank Africa, 80% of the shares, and 20 minor shareholders. It has 5 subsidiaries: Stanbic Bank, the anchor subsidiary, HB Securities, FlyHub, and Stanbic Bank Business Incubator. Looking at upside key metrics, as at half year 2021, we see that true asset increased by 14.4%, implying asset accumulation. Customer loans also increased by 9.8%. This implies that there is more interest earned. And customer deposits also increased by 9.5%. This implies more credit creation.
Looking at the industry in which Stanbic operates, Uganda is set to grow at a GDP of 5.5% baseline, and this is due to economic recovery. Central Bank stated that the inflation in Uganda has been low, and this was seen majorly because of the fact that major inflation rates declined except EFU and core inflation. Commercial bank gross loans as well as holdings in government securities increased, but due to the after effects of the pandemic, we saw that non-performing loans as well as real estate prices increased, showing that the risk of credit losses also increased because most of the collateral security from loans come from the real estate property. The liquidity risk was low due to a standing liquidity facility by the central bank, as well as the reduced cost of wholesale funding from the interbank markets as well as the swap markets. Supervised financial institutions retain capital buffers that were strong because of the restriction to dividend payment by the central bank. We used the reporters model to assess the competition of Stanbic and saw that competition in the industry from the domestic systematically important banks, as well as the threat of new substitute products, poses the highest impact. But regardless of this, Stanbic remains strong in terms of competitive advantage, as we saw the strength and opportunities of oil and gas, as well as affordability, keep it high. Moving on to financial analysis.
We used the Camel's rating to value Stanbic's financial strength and got a 1.456, showing strong performance. Stanbic's capital position has remained stable despite increase in provisions. It has increased from half year 2020 to half year 2021 against a regulatory minimum of 12%. This means that Stanbic has sufficient capital to absorb losses and reduce risks. We use non-performing loan ratio and credit loss ratio to ascertain asset quality of Stanbic. Non-performing loan ratio has had a declining trend and only increased in 2020 due to the effects of the pandemic. It has since reduced in half year 2021, and this shows an increase in earnings. Credit loss ratio has also had a declining trend and only increased in 2020 due to an increase in impairment charges by SMEs, forming the biggest portion of non-performing loans. It has since increased in it has since declined in half year 2021, and this shows strong customer quality portfolio. We used profit after tax per employee has had an increasing trend over years and only reduced by a small portion in 2020 due to the effects of the pandemic, and this shows strong management capability of Stanbic. We use return on equity, return on assets, and cost to income to value earnings. The profitability ratios have had a declining, fluctuating trend over years, and as at half year 2021, they have increased, and this shows companies' efficiency in managing equity capital and sustaining profitability. Compared to their peers in East Africa and Uganda, Stanbic has an impeccable performance via return on equity. We use loan to deposit ratio to value Stanbic's Stanbic's liquidity. It has had an increasing trend over years against a risk appetite of greater than 80%, and this shows a strong liquidity position of Stanbic. We use interest rate risk to value sensitivity to market risk, and Stanbic has had a stable banking book and trading book interest rate risk within their tolerance levels. Moving on to valuation.
We valued Stanbic's bank stock using both intrinsic and relative valuation, where a two-stage model that looks at a high growth rate in the short term as well as a long-run lower growth rate in dividends was used because of Stanbic rapid expansion, as we saw new subsidiaries being introduced, and we got 34.85 Uganda shillings. The golden growth model that looks at the series of future dividends growing at a constant rate was used due to the stable dividend per share growth, and this gave us 36.52. Residual income model was also used, and this looks at the present value of future dividends plus the book value per share, and this was used basically to assess economic profitability, and it gave us 34.79 Uganda shillings. The price to book and price to earnings relative valuation multiples compare Stanbic's multiple to the peers average, and here we got a price to book value of 21.63 as well as a price to earnings value of 42.83. Moving on to ESG.
In positive relation to our valuation, the holding company has also steered up good environmental practices, and this is seen through the declining economical matrices, such as the paper consumption, which reduced by 29% due to the digital onset of the holding company. Carbon emission and fuel consumption also reduced significantly as a result of the holding company focusing on the reduction of diesel consumption in their vehicles and their generators. This illustrates that the holding company not only focuses on profits, but also on environmental safety. The holding company has also maintained strong relationship with the people, and this is through programs such as the Stanbic Championship that has helped to impart skills in students. Furthermore, the holding company has also enhanced customer value propositions, especially in 2020 when the pandemic actually hit, through online lending and online account opening. There has also been increased corporate social investment, and this helped the community during the pandemic, whereby over 3.4 million shillings was donated to the society. The holding company has also increased its spending on its employees to promote efficiency and productivity in their working place. Coming on to governance, the holding company has maintained good corporate governance, as this is seen through the separation of its board into non-executive directors, executive directors, and the non-independent directors, which is promoting independence and unbiased judgment. Furthermore, the strong board audit committee of Stanbic Holdings Uganda continues to audit the internal auditors' work, relating them and actually liaising them to the external auditors, which promotes efficient operations in the organization. It has also motivated its managers and its employees through steady increase in salary and employee benefits. Furthermore, we assessed our corporate governance using the OECD principles, which resulted into an impeccable performance of an 80.5%. This shows that the holding company has good corporate practices. In addition to despite our evident reasons to defend our buying recommendation, we still believe that the holding company is prone to risks. A risk matrix was conducted to assess the impact and likelihood of these risks on the holding company, whereby we identified two key major risks, and these are the credit risk and operational risk. Furthermore, a Monte Carlo simulation was also conducted to simulate future possible prices of the holding company, which enabled us to estimate our target price for 32.05 with a hybrid probability. Lastly, a sensitivity analysis was also conducted considering the cost of equity, dividend per share, on our target price, where we observed that despite the fluctuations, our target price still stands above the closing price, confirming our buy recommendation. We stand strong and conclude with a buy of 32.02 Ugandan shillings. Thank you.
Thanks, guys. No questions.
No questions. That's it. Oh, okay, yeah.
It can just by default.
By default, yeah. Correct.
By default. Because we elected all everyone has such one is
Good afternoon, everyone. Team 4 initiated a coverage on Stanbic Uganda Holdings Limited and came up with a target price of 32.05 Uganda shillings, stamping a buy recommendation with an upside of 28.2% from last close of 25 shillings on 14th January 2022. Our decision is supported by 3 pillars, namely SBU strategic reorganization, its steady growth in net interest income, and its unique positioning in Uganda's oil and gas sector. Now, SBU has come a long way from its inception in 1906 as the National Bank of India, and after a host of name changes and finally listing on the stock exchange, it reorganized itself in 2018 to better invest in the Ugandan economy. Now, as a holding company, it's involved in anything from banking to property management, business incubation, capital markets, and financial technology. It's no wonder that it's the largest bank in Uganda, having the widest coverage in terms of agents, branches, ATMs, and customers. Its banking subsidiary contributes the largest proportion of its revenue, though that is going to change in the future with its other subsidiaries. Its banking segment is divided into 3 main divisions, which are the business and commercial clients, the consumer and high net worth segment, and its cash cow, the wholesale segment, which constitutes of personal and business banking, and made over 223 billion Uganda shillings in 2020. So, why should we invest in SBU?
Thank you, Ian. We believe the market has underestimated SBU's potential in strategic organization. Historically, SBU has maintained its top position in the banking sector and gained potential to tap into other different sectors. The banking sector has contributed 15.7% CAGR of interest income since 2018. The Stanbic Properties Limited has contributed 28.2% growth of comprehensive income, and FlyHub has onboarded 87% of SBU's clients on the various TikTok platforms. Hence, with all these strategies, SBU has managed to enhance its value. This is through cost reduction and diversified revenues, steady growth in net interest income. This is mainly driven by the 20.1% growth in corporate loans and the declining lending rates, making SBU in a good position or the lowest lender in the market due to the accommodative monetary policy. This is further expected to accelerate the growth in net loans and advances, coupled with the declining non-performing loans, hence improving SBU's asset quality, profitability, and enhancing the value as well. Unique position in the oil and gas sector. SBU is well positioned to provide the project finance, advisory services, and training the SMEs to tap and training the SMEs to participate in the $10 billion project, where SBU is expected to exploit 60% of the 10 billions. To expect part of the 60% of the 10 billions of this oil. This will enhance its value through diversifying its revenues or increasing its revenues, hence improving its value. Judith, how is the industry?
Thank you, Ismail. Under industry, the GDP declined from 6.8% to 2.9% as a result of the impact of COVID-19, which saw a sharp contraction in business activity. We anticipate that the GDP will increase to 3.9%, putting SBU in a better position to recover its income, hence increase its net interest income. In a bid to reduce the impact of COVID-19, the central bank carried out a number of monetary policy actions. It reduced the central bank rate from 9% to 7%. SBU took advantage of this and became the lowest lender in the market. The 2020 registered a decline in the private sector credit growth from 12% to 11%. Despite this decline, SBU remained the strongest contributor to the different sectors under private sector credit growth. Under competitive positioning, SBU is the market leader by assets, customer deposits, and has a high operating efficiency. It is a market leader in net loans and advances to customers. We assessed SBU's competitive positioning using the Porter's 5 forces and concluded that the threat of new entrants is not a threat to SBU because of the restrictive capital requirements to join the industry. However, it faces a high threat of substitutes and a high bargaining power of consumers due to the high penetrative power of other financial service providers. Monica, how sustainable is SBU?
Thank you, Judith. SBU is highly committed towards obtaining its sustainability goals, and this is through integration of ESG and SEE, which is in line with the UN 17 sustainability goals. Environmentally, we can see SBU has reduced on its carbon footprint and electricity consumption. Socially, as we can see, SBU has invested a lot of money in social events. For example, we can see it has paid tuition to over 60,000 students and 200 million in the health sector. We as well assess the governance of SBU basing on those five parameters, whereby we came with a score of 83.5, which was a very good one. On the side of gender composition, we see a good number of female representatives on both the board of directors and the executive management, which shows that SBU is moving towards a balanced gender. Leon, take us through financial.
Thank you, Monica. We gauged SBU's financial health and found it to be in great condition. It returned 20.5 as a return on average equity, which was double the industry average, showing it to be very profitable. Its earnings per share also hit the 5 shilling mark and is projected to grow even further in the forecasted period. It also has a very attractive PE ratio relative to other banks in Africa, making it the top choice for value investors. On top of that, it's enjoying the benefits of positive jaws of efficiency, having a low CTI ratio of 48%, while having a CAGR of profits after tax of 6.04%. Historically, SBU's foundation has always been its strong capital base, and it has managed to keep that well above regulatory limits, even with the Basel III amendments recently. It also has pristine asset quality, having loan-to-deposit ratios of 60% and stifling non-performing loans under 6% even during the pandemic period. It's also well covered in terms of liquidity to invest in other markets. It had a 12.4 posting of liquidity coverage in 2021, and it has interest earning assets to total assets at 78% currently. So how did we value Stanbic Isaac?
Thank you, Leon. Reaching our target price of 32.05 Uganda shillings, we used the DDM model, the residual income, and the comparables model that we rated 40, 40, 20 respectively. Our dividend discount model suggests an upside, whereby we use the cost of equity at 15.55% and the terminal growth rate at 10%. Our residual income leads us to a 28.08 target price, still with the use of the same cost of equity and the terminal growth rate this time at 3.2, using the expected growth rate in the GDP. Our comparables was made based on the PE and the PPV ratio that we found falling under the industry average, which means that this company is undervalued. And further, we made a regression analysis and we found SBU falling under the regression line, further stamping that this company is undervalued. In sensitizing the DTM, we found our terminal growth rate being most, our target price being more sensitive to the terminal growth rate, whereby rather we expect if in case there was a change of this terminal growth rate by over 4%, that's when we would change our recommendation. Then in our residual income model, it was more sensitive to the cost of equity. It was more sensitive to the cost of equity. Rather, it would require over a 20% change for us to influence, for us to turn our recommendation backwards. In our Monte Carlo, we ran 10,000 accelerations, and our target price happens to fall between the 75th and the 80th percentile, further confirming our recommendation with an almost 80% confidence that it will go in the same direction. Our risk matrix identifies the cyber risk and the pandemic risk. The cyber risk, although it has a high probability of happening, it may have a low impact on the company based on the techniques used by the company. The pandemic risk, however, may not have a high probability considering the mass vaccination going on in the country. For these reasons, the strategic reorganization, the steady growth in net interest income, and the new positioning of SBU in the oil and gas sector, we issue a buy recommendation with a target price of 32.05 Ugandan shillings, presenting an upside of 28.2%. Thank you very much.
Thanks, guys. No questions.
No questions?
Ruth, would you like to give us guidance on lunch as we wait for the tabulation? And in the meantime, after Ruth, we shall have a communication from our sponsor for today, UAP All Vision. And after their communication, we shall receive the results and be able to hand over and guide on the next steps for the winners. Ruth, just take us through quickly about lunch, and then we shall invite UAP to speak to us.
Thanks, Alan. Good afternoon, everyone. We're going to have lunch on 10th floor, Summit, I think it's a restaurant, Summit Restaurant.
From the time we got involved in this, we see the quality of this is really getting higher and higher. If you can at least involve all other universities, you know, there are so many universities that are coming up. Please engage them, involve them so that it becomes really more competitive. It will move us to another level in East Africa and the world above. But the main message is really appreciation. Like Alan said, also we are here and we are looking for quality. The more the quality goes up, the more we are assured of quality also. Within the team that has been presenting, we are also looking for a junior portfolio manager. At least within you, you're seeing those are people. And like any other competition, nobody has lost, according to us, because you've all been involved, okay? Of course, in any league, there's always a winner and a loser, but here we don't have a loser, okay? One of our judges said that you can always bounce back and even be better, okay? So with that, we do mainly fund management. Okay, UAP is a big organization. We do general business, we do life business, but the main company that sponsored this is the financial services department, where we do fund management, and we have 3 products under the unit trust. That is the umbrella trust fund, we have the balance fund, and the money markets. Please feel free to go to us so that we can sensitize you more about, okay? We are generally happy that the message of finance, investments, and advisory is coming across. We appreciate Capital Markets Authority. We really appreciate also the CFA Society of East Africa for taking this hurdle on. Insurance, the main challenge we have with insurance now is awareness and investment. So, CFA, we appreciate you for that. With that, thank you for coming. Please, like I said, nobody has lost, okay? There is still an opportunity. Thank you.
Thank you, UAP of Mutual, for providing us with an opportunity to join your company through this process. I think it gives it the credibility. And also thank you for the sponsorship for allowing us to come here and network and interact with our other colleagues and participants, helping us build a community. At this juncture, I'm going to invite one of the judges to advise us on who of the two teams that reached the finals has been better or has bested the other. You don't have the results. Are we still tabulating? I think we need the results back.
We are done.
And the judges, I'm avoiding giving bad news, so I'm going to allow the judges to do that. Because in my job, I give good news, so I'll return the bad news to. Ruth, are we ready? Can we have the results? And Ruth, as well, please prepare to let us know what the winning team will be receiving and what the runners-up will be getting. We would like to know. I think that will be some exciting news as well. So we are coming to the end, to the close of our function today. I think it's been educative. It's been a blend of career guidance, competition, networking, which for me are all the top things that I wish I had as a young graduate. Being able to put on a suit in university would have been a delight. I think I first put on a suit way later, and it didn't fit. So I think having these functions where you learn how to dress up, it's important, because it will help you when you come for that interview. Should all mutual call you, I think you are better prepared for that call. And these events, we expect them to be annual going forward, and we would like to make them bigger and more involving, and we invite you to be volunteers in the future, but also to be ambassadors for the research challenge in your universities. We are receiving feedback from you on how we can improve. Please come and let us know where you think we can improve these sessions. It will be welcome feedback for us, because we want to make these the primary avenue through which students learn the best practices in the market, in capital markets. We believe a hands-on approach is the best way to teach you on what is coming next. So we welcome your feedback. You can provide it to me or Ruth or Stella. We are able to receive that. Are we ready? Good. I'm going to invite Mr. Godfrey Bukomeko to BJ. I want to be Bamba with the big boys, so I'm graduating to calling him BG. There's a mic over there. You will be doing the honors of announcing the winning team.
To be honest, this is the most difficult part of the
thank you. I figured. And that's why I jumped out of it.
Maybe I should start by announcing number 5. I'm joking. And then soothing the rest. The results placed in the 3rd position, which is the second runner-up. Team 3, which is Makerere University Team B. But before I mention the first runner-up, I have to say this. When I was a mentor, an industry mentor, a team came to meet me at the DFK house, and this team came and they were putting on jeans and shorts and t-shirts, and I asked them to go back. At the time, they did not realize the significance of being smart. But today,
the teams that presented, all three of the teams were really smart. And I was very impressed. We should keep up that tradition. It will get you very far. The second runner-up okay. The first runner-up is team number 2, which is Makerere University. I believe at that point we should all congratulate the winner, team number 4, which is Makerere University. Team 4, please come forward and we take a picture with your judges. Congratulations, Team 4. This is Team 4 from Makerere University Business School. Let's wait for all the judges to come forward. George, you can remove the mask on the sleeve. Wow, congratulations. It's been a long time coming for MOOPS. This is what, the sixth year? No, you won one time, no?
We won the ethics challenge.
It was ethics, not research. Wow, you guys are persistent.
Yeah.
I love that. It's important for markets to stay in and think long term. So we are waiting for our gifts for the team. In a few minutes, would you guys like to say something? Yeah, I figured. We have a mic over there. Plus another one here.
Thank you so much to everyone from the CFA Society, the Capital Markets Authority, and UAP and Old Mutual, and everyone else for coming here. I believe that the mere fact that 5 teams came here signifies something great for Uganda. A more diversified, more active capital and financial market where people can actually trade and have knowledge, and this access to knowledge, having these skills allows other people to have access to this knowledge through the services we provide. I've been so interested in the Uganda Securities Exchange and other investments, but I feel bad at the lack of professionals, and I feel that every student who takes it in their initiative to even just try to think about CFA is doing something so big. I feel all of us here are winners. It's been a personal journey. When I registered for this competition, I thought it was going to be a walk in the park. I was too arrogant. I was humbled in one day, knowing how hard this is. But the thing about such things, they're like marathons. Marathons are hard, but they're easy when you do it one day, one step at a time. And we did a lot. We put aside our Christmas, put aside our holidays. We came through on those days. We made that difference. We thought, if other teams are working hard, let's also work when they are not working. People sacrificed our holiday season, even while we were in examinations. We had to file our report on the day of an examination. Personally, I had a lot of issues that may have even prevented me from coming here, and I thank God for bringing us here. I want to make sure that MOOPS keeps coming back and doing this, but on top of that, I want to make sure that when MOOPS comes, we have good competition from other universities as well. And I trust from seeing the other presentations that we are going to fight a lot in the next competitions. I thank everyone for supporting us. I thank the judges. I thank my team for persisting with me. I'm a very annoying leader, and I'm not very good at teamwork. But the biggest lesson I learned throughout the CFA, not how to do residual income valuation or how to see the CTI ratio. The biggest benefit from this is that I learned how to do this with a team. It's a skill I never had, and I'm glad that the CFA has given me an opportunity to learn how to work as a team. Thank you.
So we have some few gifts
for our winners today. Surprise, surprise. We can say the judges will stay and help us hold this. Rules, what are the rules for this damage check? Because I can't take this to stand. I would have run already. So what are the rules?
So that's a check that represents the cash price, which we will get the details from the faculty advisor, but that money is not meant to be distributed among the teams as yet.
It's not for you.
You will invest that money.
Invest it?
Yeah.
As an investment club?
As an investment club.
So we are seeding you as an investment club?
At least 2 years, then after that you can decide on what you can do.
We have additional mementos for you.
That's great.
Yeah. I think they can have one by themselves as well.
Yeah, we should. I think let's move on.
That's all the
Yeah, some
Okay. Okay, we have a mementos for you as well. This is a memento for the member of the winning team that will be handing over as remembrance for your successful completion of this exercise. Yes, you hold them and take a few pictures. It's not for you. Don't worry. We're also going to invite the faculty advisor to receive her for successfully leading a team in the Research Challenge 2021. And we have one for the university as well. Let's all congratulate the winning team. Let's give them a The presentation was awesome. I know we have a good representative at the next level. Thank you very much, Team 4, Makerere University Business School. We appreciate. Thank you.
Congratulations.
Congratulations once again.
Up to the next level now.
We highlighted that. We did highlight to us. They worked during Christmas. That's a big story there. I used to read through Christmas, so I know what it is. We have certificates for other teams. May I request Chambogo University, a representative, to come and pick certificates on behalf of the team. Feel free to take pictures after. These are all paid for. We wouldn't want you to miss. Makerere team A. Thank you for representing on behalf of Team A. Thank you. And Makerere, Team B. Thank you again for representing on behalf of Team A. You see you. Do you have a representative? Thank you, Team UCU. So as we come to a close, we've been given some feedback that for the next research challenge, we should be hosted by the winning team so that they can have home advantage. Madam Esther, is that something we can do? That next year, should we come and take the trophy away from MOOCs? Okay. We are amping the ante, this is competition now. So the other teams will be coming to your venue and taking away the trophy. So that is something that we want to change for next year. But for today, let's all take a moment to appreciate the time, the teams for the presentations, the high quality, the high caliber of presentations here today. We appreciate you. Let's all give ourselves a very big applause. So thank you very much. We have come to the close of our research challenge, and we would like to invite you for lunch at Summit Restaurant, which is on the top floor. So as you exit, kind of pick a coupon from Ruth, and you'll be able to join us for lunch. Let's continue networking. Please share, meet with the mentors, ask them about internships. Those are the people to hire us, not me. But let's continue this conversation at lunch. Karibu lunch. Thank you again.